Good evening, members. I welcome you all for this study circle meeting on scope of Section 66 and other related sections under the Income Tax Act and recent changes in GST. Amongst us, we have the Audit Committee Chairman of ICAI, Mr. Makmeet S. Bhatia. Am I right, sir? Yeah. As a retired IAS, he's been nominated to the ICAI committee and he's looking after the audit committee of ICAI. So I request the chairman to welcome him on the dais. I also request the chairman request Vinod to escort the speaker today. Nithin. Thank you. Request the chairman to please present the booklet to the speaker. Vinod. We also have amongst us the Regional Council member Pramod Avade. I request him to come on the box. Instead of, I would like to introduce today's speaker, CA Nithin Surana. Nithin Surana is a chartered accountant and a partner of Barlecha, Surana and Associates, Bangalore. Nithin has previously worked with HC Kancha and Associates and also Jitin Christopher, Shrikant and Shrikant, with special focus on areas of direct tax consultancy, litigations, transfer pricing and international taxation. With over 8 years of post-qualification experience, he has worked on assignments involving a range of domestic and international tax and regulatory issues, litigations and consultancy services at various entities, including listed multinational companies as well as high net worth individuals. He has represented clients before various income tax forums and tribunals. Nithin has also delivered lectures at Study Circle on income tax topics. That's a brief introduction of the speaker. I would request Mr. Bhatia to give his address to the members present here.
Thank you, Mr. Virupaksha Bopana, Honorable Chairman of the Bangalore branch, Mr. Manjunath, Mr. Pramod. It happened that I was on a visit to the Bangalore branch today, so the chairman requested me that do have a look at how we go about our CPE programs. I'm delighted to be here. I think we're already 15 minutes late, so I'll just keep it short. As you must be aware, the Central Council has 32 elected members, and there are 8 members who are nominated by the central government. And these nominations take place coterminous with the council term. So while the council came into existence in March, the government nominees, we were nominated in the month of June. And to be honest with you, having worked in a government setup for the last 35 years, it's been a very exciting 3-4 months that I've spent in the ICAI, and I was just telling Mr. Manjunath that it's a very well professionally run body. When we compare how we do our business in government also, the ICAI is also very well organized, very professionally organized, and there are two outstanding facets of the whole setup of ICI and its entire structure. The number one, which I find most fascinating and I think most laudatory, is the fact that so much is done for the students. You know, the students who are aspiring to become chartered accountants. The kind of effort that goes in at all levels, right up to the branch level, in facilitating and helping the students take the examination. I think no professional body in this country can match the effort that goes into helping out the students to take up this challenging exam. And I think the credit goes to the entire community as a professional body. And the second fascinating lesson for me in the last 3-4 months is how much effort and how much desire there is for the professionals in this body to keep enhancing their skills and keeping in touch with what's happening. The kind of CP programs that are organized, and I'm fortunate to be here, and I'm actually surprised and pleasantly surprised that you have it every Wednesday, which is once a week is actually very creditable for somebody who comes from outside the profession. I think within the profession you take it as given, but the need and the emphasis on continuously learning and improving your skills, because at the end of the day the advice and the actions you take are so critical for so many aspects of our financial systems and economy. So I won't go further. I haven't specifically come for this particular program. I just happened to be here, but I'm very happy to be part of this, and I'll try and stay for at least 10-15 minutes for the talk. So I don't want to hold back the speaker. Thank you very much, and my best wishes to all of you. Thank you.
Thank you, sir. So I will be, without wasting much of the time, I would request the speaker to take up his lectures.
First of all, good evening all of you. Thank you so much for making it. I'd like to welcome Mukmeet sir also for gracing this occasion, and also Manjunath sir. I've tried to cover the provisions of section 6 in as much detail as I possibly could. So I don't know if we will get a chance to go to the other related section under the Income Tax Act. However, we will make an attempt to probably cover as much as we can as we go through the session. So before I start, probably it took me around an hour to travel 8 kilometers. So because I think all of us, it's a hot topic that the roads in Bangalore are very bad. So but the dream given to us is the roads are bad today, so that we will repair it and we'll have better roads for tomorrow. And similarly with the new act, we have been given a picture that things are going to get better as we go forward, that we have to endure the slight issues that come along when we begin with this. So I will just begin with the topic for today. First of all, just a small overview for the session, what I'm wishing to cover. Hopefully I'm able to cover all of this. First is, why was the Income Tax Act 25 even needed, the purpose, and what statistics the government has pushed out to justify that there is a requirement for an overhaul of the Act. Then we will go into a residential status. I think this is one of the most underrated sections, if I could so call it, because we take it for granted that somebody is a resident or a non-resident. And I think once we get deeper into the topic today, I think I have definitely appreciated this section now once I got to do some research over it. Then we will come to section 6 of the Income Tax Act of 2025 as passed in the month of August. Then we will do some analysis with respect to the language and the interpretation of the old Section 6 vis-a-vis the new Section 6 in the Act. Post that we will move to interpretation of certain terms which have been used in these sections, and probably also take up small case studies to probably just understand how these terms can be employed practically in a real world scenario. Then if we get an opportunity, we will move to probably some sort of a interplay with the DTAAs, mostly with respect to the Middle East, because there is some arbitrage still there with those countries with respect to DTAs. So we can discuss some of the cases there. Into the topic today, I think I have definitely appreciated this section now once I got to do some research over it. Then we will come to Section 6 of the Income Tax Act of 2025 as passed in the month of August. Then we will do some analysis with respect to the language and the interpretation of the old Section 6 vis-a-vis the new Section 6 in the Act. Post that we will move to interpretation of certain terms which have been used in these sections, and probably also take up small case studies to probably just understand how these terms can be employed practically in a real world scenario. Then if we get an opportunity, we will move to probably some sort of a interplay with the DTAAs, mostly with respect to the Middle East, because there is some arbitrage still there with those countries with respect to DTAs. So we can discuss some of the cases there. Okay, yeah. So in the budget speech of the financial year 2024-25, the Honorable Finance Minister announced that comprehensive review of the Income Tax Act 1961 was needed. That it was the need of the hour. The purpose was to make the Act concise, lucid, easy to read and understand, thereby reducing disputes, litigation, thereby providing tax certainty to the taxpayers. I think this has been the goal of the finance department for a very long time, to give certain certainty and reduce litigation and disputes. The need for the new Act, the reasons all provided by the government were that the Act has been amended 65 times with more than 4,000 amendments over the last 6 decades. So what we are currently still, over the past 6 decades, still discussing the nuances, the technicalities of a section, says that this is probably a never-ending topic. So something which was amended 65 times over 4,000 and 4,000 over 6 decades. And there were 19 separate amendment bills which were passed. Coupled with this, there was extensive amendments, numerous exemptions, deductions. There was a traditional legal structure, fragmented structure, and outdated provisions. Basically, there are a couple of provisions which are already met their sunset, but which still continuing in the Act. Needed to be rooted out and to make the Act probably simpler and more concise. So these were a couple of reasons which pushed them to probably have a look at the Act again in a new way. As per the press release dated 3/9/25, the Act was reframed on the following principles. So they started out by saying that we will not completely overhaul the Act. We want the certainty that has been built over the last 6 decades to stay in the Act. We will just try to make it more simpler and easy to read. So textual and structural simplification for improved clarity and coherence. No major tax policy changes to ensure continuity and certainty. No modification of tax rates, preserving predictability for taxpayers. In essence, the Act is designed not to overhaul tax rates, but to just overhaul the tax experience, is what the government came out to say, making it more predictable, efficient, and digitally enabled. Now, this is probably the statistics which are put out by the government themselves to probably show to the country and the professionals, look, this is what we have clearly done. Because nobody would believe you that we have simplified the Act until you give them some statistics. So what they have done is they've basically said that there are around 5 lakh words in the old Act. We have already cut it down to half, which is 259. Then there are 47 chapters, we made it 23 chapters. There were 819 sections, we made it 536 sections. So a great reduction of about 283 sections. Tables have increased from 18 to 57. So probably they have tabulated something like a TDS chapter itself in entirety, so that you don't have to go to couple of pages. Everything is probably available like a ready reckoner. And formulas which were probably 6 under the old Act, that let's say with respect to computation of, let's say, a 50B slum sale or some sort of valuation which was there. Now that has been increased to 46. So basically, they're trying to make it more user friendly. Is a better way to put it. Now, why when I started, I said that residency section 6 has become important again. It's very, I think, necessary to understand the movements happening across the globe. So as of 2024, India has the largest immigrant population in the world, with over 1.85 crore Indian-born individuals living overseas. And 25 lakh immigrants migrate abroad every year. So these are basically the opportunities that are being created outside India. There is a talent shortage, there is a workforce shortage in different parts of the world, and hence you will see a large outflow of people from India. Probably currently, I think the biggest market being the Middle East, then going to the Western countries, probably US, UK, so on and so forth. And the number of Indian migrating abroad for work nearly tripled from COVID. So basically, we can say that COVID was the trigger for a lot of them to move out, because I think most of them understood that talent will now become important if we are to face some sort of a pandemic again, and that talent will become important going ahead. Then reflecting also a rise in opportunities and relaxation in travel restrictions. I think 1 year post-COVID, not all of us were able to move as freely. And I think once the gate opened up, they opened up for good. I think a lot of them either went out or came in. And 60% of NRIs, after probably living their life outside India, earning their wealth, plan to come back to India for retirement. Majority markets being the US, UK, Canada, Australia and Singapore. And also, just as a recap, I think a lot of companies also have reverse flipped back to India. For example, Flipkart has now come back from Singapore to India, and a couple of other big companies have come back. So I think all of us are seeing opportunity in India, and therefore everybody wants to come to India. As a result of all these, what I've just spoken about 30 seconds back, India is the world's largest recipient of remittances from its diaspora. So basically, in financial year 2024-25, a record $135.46 billion was received in India from basically just Indians outside India, pushing money back to their home country. Now, so just starting with today's topic, I've tried to capture the old and the new sections in a concise table for all of you, just probably to give you a snapshot of how the sections have panned out in the new Act. Earlier there were 6 sections with a couple of explanations and subsections, so on and so forth. Now this has been broken down into 13 subsections in section 6. So basically 6.1 earlier immediately began with individual be a resident if he stays in India for 182. Now what has happened in the new Act is they have probably given an introductory beginning to the section saying, for the purposes of this Act, any individual in a tax year will be a resident and his residential status will be computed in the sections going ahead. So probably 6.1 is probably kind of just a starter to the section. The section begins with 6.2, which is equivalent to the 6.1 of the old Act. It stays, all the conditions more or less stay the same. Total period of stay greater than or equal to 182 days, or cumulatively stays for 60 days, 365 in the last 4 years. 6.3 is basically if it's a member of a ship or he goes out for the purposes of employment. This is equivalent to explanation 1 of section 6.1a. Then 60 days is sought to be pushed to 120 if it's a citizen of India or a person of Indian origin. That was 6.4 now, it was 6.1b earlier. Person referred to in 6.4 with Indian income greater than 55 lakhs. So basically, this is an income threshold that was introduced. Even for them, the number of days was increased. So this again was 1b, has become 6.5 now. 6.6 for member of a foreign ship leaving India. That was explanation 2 to 6.1. It is 6.6 now, a separate subsection in itself. Deemed residency, it was 6.1a, now it's become 6.7 of the Act. Basically, a citizen of India not liable to tax in any other jurisdiction due to his domicile, residence or other similar criteria, along with a monetary limit attached to it. 6.8 to 6.12 are probably sort of the factors which deal with other than individuals, which deal with the place of effective management, HUF, residency, and other sort of things. These are now been covered in 6 to 6.5, so the old Act. Now 8 to 12. 6.13 now deals with the entire RNOR section. So it's earlier 6.6 in the old Act. Now, So we'll jump right into the analysis of the sections. So like I said, that 6.1, it's the introductory or opening portion of the section, and states that the residential status in India in a tax year of a person shall be determined as per the provisions of this act. This is just an introductory portion. This was missing in the erstwhile act. The earlier act, I think, just straight away began with saying you are a resident if you satisfy these conditions. The need or requirement for the introductory portion is uncertain, debatable, not required. Is it surplusage? Then some drafting issues persisted in the first version of the act, which came out earlier. I think once they took up the comments from the industry and also the public comments, I think this was earlier. It stated that currently it states that, like I read earlier, residential status in a year. Before it said residence. So there are a couple of mismatches in a couple of places in the act. This was then rectified now, and I think to remove it completely would have not looked good on the part, so they've kept the introductory portion with the change in the words. That's still there. No, so what I've tried to do is I've kept the old act. I've also reproduced the new act and differences which I have noticed in the terminologies which have been used in both the old and the new act. I hope it's visible. I've kept the font small, so in case if I need to be zoomed, you can just let me know. Anyways, I'm going to read it out. So the old act, as we know, had subsection 1, B was deleted, and then C. A basically stated. Now the words which I want probably all of us to concentrate on would be is in India in that year for a period or periods amounting in all to 182 days is what the old act said. Now the new act, if you just come down to the new act and read the subclause A, it says is in India for a total period of 182 days. So therefore what was period or periods amounting in all to 182 has now merely been replaced with two words which means total period. Now can this cause an issue? Is that first? But again we'll have to go with the ideology of the government saying that we don't mean to change anything. What was there before, the ethos of the act still remains the same. All positions remain the same. But we as chartered accountants like to play with the terminologies of the act. So I don't see this not going to the courts. I think definitely somebody is going to take this up. But so like I said, it used period or periods amounting in all in the earlier act. Now it uses merely two words to say total period. Now again, this probably is going to cause unintended issues because the word period has been meant to be a fixed length of uninterrupted time. So basically when I mean to say uninterrupted time means a continuous period of stay. So tomorrow somebody can argue that I was not in India for a continuous period of 180 days. I went for 60, came back for 20, went for 10, came back for 80. So if somebody wants to argue tomorrow, can say that period can mean a continuous period of stay. This was held in the decision of B. Shah versus presiding officer in the Labour Court. In the Supreme Court, it's a 1977 case law. You never know when these crop up and they're being used in the courts. So probably just one way of looking at this. And also, the said provision does not use the word period or periods. The said clause may be compared with 6.1 of the Act which is done. Uses the words for a period or periods amounting in all. Even 6.6 of the earlier Act uses the word the total number of days in a year. So one more way probably somebody can counter me right now is saying they're using the word total period. So total would then mean a sum of everything. So total period probably is getting into its for the entire period I have stayed in India. So that is one way of looking into it. Moving on, clause B, the said clause uses the word during the year. Instead of the word during that year, should have been used to avoid any interpretation. So basically if you see, if you read the new act, is in India cumulative for 60 days or more during that year. Probably they should not have been used during that year, should be specifically used during that tax year. Because that year is still leaving the words open to interpretation. So it would have been probably more apt to use more definitive words. Because if you see in the ending, it says 365 days or more in that 4 years preceding such tax year. So when they have used a tax year in the ending of the section, probably they could have used it during that tax year, even in clause B. But I think because we are saying that the principles remain same, we will interpret it the same way. Now moving to analysis of section 3, 4 and 5. Now the old act basically here dealt with somebody who was going outside India on a merchant ship. That was clause A. Clause B was a accumulation of two things. Probably And clause A also dealt with somebody who was moving out of India for the purposes of employment, and wherein 60 days were going to be substituted by 182 days. And subclause B dealt with somebody who was a citizen of India or a person of Indian origin within the meaning of the explanation. So basically you come on a visit in the previous year where 60 days was going to be substituted by 182 days. And plus there was an income threshold which was added, which was for about 15 lakh rupees. Now, if we read the new act, it says the provision of such shall not apply in the case individual who is a citizen leaves India in any tax year. Again, any tax year being the operative word here. Again, the same thing in clause 4. It says who being outside India comes on a visit to India in any tax year. 4B. If all of you can just follow 4B. Who being outside India comes on visit to India in any tax year. So 3 in the ending uses any tax year. 4 clause B in the end uses any tax year. Then 5 basically is saying that 4 will not apply and where a person has an income exceeding 15 lakh rupees. So the difference basically is that the language suggests that a person would be entitled to benefit eternally. Ideally what case laws have held is that you get the benefit of the 180 days only in the year you leave the country. It is not available to you for an entire eternity. So what they have done by using any tax year is now left it open for anybody who wants to use the sections to say, I will use this probably every time I leave India and come back, I will say I went out for a purpose of employment. So any tax year probably should have been again, should have been that tax year and not any tax year. That should have been made clear. So basically, if eternally he leaves India in any tax year for the same is not the intention, as the benefit is limited to such only on that tax year that he leaves India. So basically, even in clause 4, the language suggests that a person would be entitled to benefit eternally if he is a citizen of India or a person of Indian origin as being outside India who comes on a visit in any tax year. So basically, any tax year has left the gates open. Probably, I think as going forward, mostly probably this is also going to be plugged. Clause 5, the placement of the words bracketed other than income from foreign sources not appropriate. The same is to be placed after the words total income because it kind of creates a circular reference. Either do you compute 15 lakhs first or you go to the residency. Because let's say I am an RNOR, then only certain types of income are taxable to me in India. And they say you compute 15 lakhs, then you become an RNOR. So the problem is, how do I compute 15 lakhs when I don't know the status? So it's kind of a circular reference. So this probably needs some clarification going ahead. Now analysis of 6.7 to 6.12. 6.7 is dealing with deemed residency. This is more or less paramateria with the provisions of the earlier act, that is 6.1a, and not many changes have been made, at least in terms to the terminology used. Other sections, that is 6.8, 6.9 and 6.7 have not undergone any change from a language point of view. The provisions of 6.10 dealing with the place of effective management of a company, the erstwhile act provided reference to an entity which probably did not sit well. Now it has rather been worded for the better, and now the words company has been used instead of entity. So once the section is read in entirety, it will make more sense. Now 6.12 provides that if a person is resident in any tax year for any source, then all other he will be taxable for all other sources as well. So basically what experts, commentaries and even court judgments have said, that you cannot be made a resident for each source. Once you are a resident, all sources of income are taxable. You cannot be made resident source wise. So basically this, in the eyes of experts and also a couple of commentaries have clearly stated that this probably is surplusage, it is OTOs not required, because the clause need to be omitted as determination of residential status is qua person and not source wise. Hence a person cannot be resident for one source of income and be non-resident for another. Moving ahead, 6.13, which is RNOR, is also paramateria to section 6.6 and deals with the provisions relating to resident but not already resident. However, to the exception that the words cumulatively have been used instead of period or periods, amounting in all, used in the erstwhile law. So basically the earlier law used again the terms period or periods amounting in all to 182 days, basically less than 120, greater than 120, less than 182. So the terms used there were period or periods amounting in all. Now this has been converted to one word, basically they have used the word cumulatively now. So similarly, one of my observations were probably cumulatively could have been used in 6.2 itself. Rather than using the word total period, they could have used a resident who cumulatively stays in India for a period of 182 days. Probably this would have given a better understanding rather than using the term total period. Now, just a summary of section 6, how it works. So basically, clause 6.2b is overridden by 6.4. So if we just go back, 6.2 is overridden by 6.4. So basically it says 60 will not be counted anymore, 60 will become 120 if you are a citizen of India or PR being outside India. So basically 6.2 overrides 6.4. Then 6.4 is modified by 6.5. Basically 6.5 attaches an additional condition of the income, which is 15 lakhs. So therefore 6.5 modifies 6.4. Then 6.7 overrides clauses 6.2 to 6.6. So basically, if you deem residency, it starts with the words irrespective. So basically, whatever is stated in 6.2 to 6.6 will not apply for a deemed resident. So 6.7 will therefore override 6.2 to 6.6. However, 6.8 overrides 6.7 depending on the outcome of the application of 6.2 to 6.6. So basically, 6.8 says if you are a resident as per 6.2 to 6.6, 6.7 cannot apply. So therefore, we are making a statement that 6.8 overrides 6.7. Therefore, if a result of the outcome of application of 6.2 to 6.6, you are determining that a person is non-resident, then 6.7 will come into application. And if you are telling that no, he is a resident, then 6.7 will not apply, because deemed residency will not apply to somebody who is already a resident under other provisions of the Act. Further, if a case is covered under 6.5, in a case covered under 6.5 where clause 6.2b stands modified to 120 days, if a person becomes a non-resident, he will still be hit by 6.7 to become a resident. In such a case, he is a person not already resident. So therefore 6.13 will apply to him. And similarly, the vice versa will apply once he becomes a resident. Now we can move to interpretation of certain terms and certain issues that still persist in the old as well as the new Act. So under 6, so first I have divided basically this interpretation into 2 to 3 sections. One basically relating to the computation of stay. Second being what does the term purpose of employment mean? Does it mean only employment? Can we take other income sources or in other activities also into the sphere of what employment will envisage? So on and so forth. As we go ahead, we will have a chance to discuss that as well. So firstly, we will start with answering the question as to whether continuous presence is a must in India. I think nowhere in the Act does it state that you have to continuously reside in India for a period to be held as a resident of this country. Physical presence is all that is required. It is not necessary that the period of stay must be continuous or active, nor is it essential that they should be at the usual place of residence, business, employment of the individual. So basically, anywhere you stay within the Indian boundaries, physically if you are here in India, those days are going to be counted towards your residency. Continuous presence is not required. And also a departure from FEMA takes into consideration also your intention as soon as you enter India. So basically, FEMA has two kinds of residency. One is the 182 test, which is similar to what we have in the Income Tax Act. One is the intent test. So basically, the day you enter India and you say that I'm going to stay here for the next 5 years, you become resident immediately. But thus, that sort of test is not there in the Income Tax Act. Income Tax Act is purely based on physical stay in India. Now, couple of other things that can arise as issues when we deal with residencies. Basically, now let's say somebody has come to India and now he comes to you and say, now help me compute the number of days I've stayed in India. So now, do we have to include the date of arrival in the number of days computation? Should we exclude the day of arrival? Should we include the day of departure, exclude the day of departure, or both should be included or both should be excluded? Now here we have support from a couple of commentaries as well as case laws. So the OEC model commentary in para 5 to article 15, the days of physical presence method, it states that both the day of arrival and departure are to be excluded for the purpose of computing stay. Similar, I think this should be included, has been included for the purpose of computing stay. Similar finding has been by the ALR ruling in petition number 7 of 95 to 23 ITR 462. So basically this saying presence in India means they take it very literally. When you land in India, you are in India. When you leave in India, you are in India. So basically both the day of arrival as well as the day of departure, both are included. Please read this as being excluded. I will have this corrected. Both to be included. Now we have a couple of Indian judicial precedents who also have dealt with this issue, which say that only the day of arrival is to be excluded. This verdict now has probably become a good law because a number of courts have accepted it. Also, there is a consensus among both the courts and the taxpayers on this issue that only the day of arrival is to be excluded. So these judicial precedents, basically there is one decision of Manoj Kumar Reddy, 34 SOT 180, which has been also approved by the Karnataka High Court in 201 Taxman 30, which has relied on the Section 9 of the General Clauses Act, which says that the first day always has to be excluded when we are computing a limitation period. So on basis of the General Clauses Act, the Bangalore High Court as well as the Karnataka High Court has said the first day, that is the day of arrival, is to be excluded. Now, exclusion of any specific days. Now, can you say when you have come to India, I will exclude certain days when I am here in India. Let's say holiday, a festival, I'm sick. Can these days be excluded? Currently, there is no direction in the Act, but we do get a sense of what has to be excluded from the OECD model commentary, that is para 5 again. I will just read out the relevant extract quickly. Under this method, the following days are included in the calculation. It is part of a day, day of arrival, day of departure, all other days spent inside the state of activity, such as Saturdays and Sundays, national holidays, holidays before, during and after the activity, short breaks, training, strikes, lockouts, delays in supplies, days of sickness, or sickness in the family as well. So basically you cannot make any other reason to say that please exclude this day because probably I was not in office is not valid. All of these will have to be included. Now, clarification in respect of Indian citizen being a crew member of a foreign bound ship, I think this had faced some litigation and then this was then clarified by the CVT by saying that the date of joining the ship and the date of signing off from the ship as per the continuous discharge certificate are to be excluded. So basically you get a certificate from the ship saying you are on the ship for so long, and that is basically what is considered for the purpose of taxation. Now substitution of 60 days with 182 days, that is what we read earlier. Now is this applicable in the year of leaving or even in the year of return? Like we discussed earlier, currently it has been left open to say any tax year. The earlier law had kind of settled this to say no, we will only consider the year of leaving. It is only when you leave the country in a particular year to find employment in another country is when we are going to give you the extension of 60 becoming 182. That is the only year you are going to get a relaxation. It cannot happen very often that you go and keep coming and keep getting the relaxation year to year. So basically the courts in Sri Anurag Chaudhary, there is the AR decision, and Manoj Kumar Reddy, which I mentioned earlier, a Karnataka High Court decision, clearly stated that it is only applicable in the year of leave. Now, the manner of computing 60 days in the year of your, when you are returning permanently, any earlier visits to be excluded. The earlier visits during the employment should be excluded if the permanent returns, if the person returns permanently. So basically, if you come back with the intention to say that I will now live in India permanently, then you are no longer going to get the benefit of 60 becoming 182. The words which are used in the section is visit. Visit means you are not coming here permanently, it is only temporary. You always have a will to go back. That's why the words are used are visit. And therefore, once you say that no, you are going to permanently stay back, you cannot avail the longer timelines which are in the Act. So I am just going to read the relevant extracts. If all the entries in India for the purpose of visit, then the period of 60 days as mentioned in Section C will be substituted with 182 days. However, if in the previous year the assessee has come to India permanently after leaving his employment outside India, then the explanation B to Section 61C will not be applicable. Basically, this gives reference to the earlier Act. which extended the timeline. It says it will not be applicable if you are permanently going to come back to India. Now, we'll just probably take up a small case study to probably just understand what we have discussed in the last 20-30 minutes or so. So basically, let's take an example that where Mr. R is a citizen of India, was an employee of X Private Limited. On 21/3/24, employer issues a deputation letter to Mr. R. A deputation letter basically saying, please go outside the country and work for my company there or work for my sister concern there. And he was sent to work in the USA. As per the deputation order, Mr. R was to remain as employee of X Private Limited. So basically, he still remains as an employee. Mr. R left for the USA on 1/2/2024. And from April 24 to Jan 25, he received salary there. During the aforesaid period, Mr. R visited India from 18/8 to 6/9. So basically, he was in India for 13 plus 6, 20 days in India. On 31/3/25, R came back to India on a permanent settlement. Now, like we just discussed, so basically, let's determine the residential status of Mr. R for previous year 24/25. The condition prescribed in 6(3) of, that is the Income Tax Act 2025, has to be applied in the year of leaving country. So basically, the phrase that year becomes relevant. So here he actually left the country, if you see, on 1/2/24. That is, he left the country in the financial year 23/24, not in the financial year 24/25. Section 6(3)(b) applies only for person visits India, that is, comes into India with an intention to leave. Like again I mentioned earlier, it is very temporal. The stay in India is very temporal, not meant to be permanent. If the person comes to India with an intention to settle down permanently in India, such person would not be covered by the ambit of the said section. Basically, he will not get an extension of 60 becoming 182 days. Day of arrival to be excluded, like we discussed earlier. And the period of stay in India account of occasional casual visit to be excluded in completing 60 days. So basically, when he came for 20 days in the middle, that can be excluded when we compute the number of days for this year. Now, moving on from the issues which were prevalent in the computation mechanism, now we can probably move to some issues which arose previously with respect to the meaning of the word employment, which is for the purpose of employment, which is already used in the section. Now, whether temporary visits are considered, basically you go for 2 months and you come back. Is that something that is going to be considered? The judicial precedents have clearly stated no. In the decision of K.Y. Patel, that is 33 ITD 714 Bombay High Court, and Abbott Laboratories 1989, 31 ITD 183, again the Bombay High Court. I'll just read out a snippet from that decision. Explanation A to clause C of subsection 1 of subsection 6 can have only a restricted and well-defined meaning, inasmuch as leaving should not be physical only, but also with the intention of staying abroad. Now, what really happens is when you read the act, you don't get a semblance or a clue that they're still looking at intention, because it's all number of days, it maths. When you go to courts is when they start injecting a sense of intention into your actions. So basically here they are saying that along with not only physical stay but also the intention of staying abroad on a permanent or semi-permanent basis is required. Merely undertaking tours abroad in connection with unemployment in India cannot attract the application of explanation A so as to convert a resident into a non-resident. Therefore, the SSC's claim for non-resident status would have to be rejected. So basically, short business trips cannot be considered as you're going out and coming back for the purpose of employment. There has to be some intention to stay abroad on a permanent or a semi-permanent basis. Now, whether self-employment or business or profession is also covered within the ambit of the word for the purposes of employment. Now, the decision of Abdul Razak, which is the Kerala High Court in 337 ITR 267, said going abroad for the purpose of employment only means that the visit and stay abroad should not be for other purposes such as tourist or for medical treatment or for studies or the like. Going abroad for the purposes of employment therefore means only going abroad to take up employment or any avocation referred to in the circular which takes in self-employment like business or profession. So, and the CBDT circular also which was released in 1982, said, with the view of avoiding hardship in the case of Indian citizens who are employed and engaged in other avocations outside India, the Finance Act has been following modifications where an individual who is a citizen of India lives in India for the purpose of employment outside India will not be treated as a resident. So basically, the circular already had stated that a profession also is included within the confines of the word employment. Now here certain issues can arise. Now basically what refers to a business outside India also. Does it mean if I have something set up here and I go there to, let's say, interact with clients and build my client base outside India, can that be called a profession? Is one. Let's say if I already have a branch office outside India, can it be said already established branch office? Can every visit of mine be said is for the purpose of profession or not? This is a thin line which probably will depend on a fact-to-fact basis. But ideally it has to be for something which you already have not done in India. That is the broad idea of what they mean by going out for the first time for the purpose of employment. Now, individuals who leave on deputation from India, like we discussed earlier, Bharat Gas India Private Limited, that is 155 Taxman 362. This is an ARR decision. If one was to notice, a lot of these decisions on residency status have been given by ARs, because I think individuals or companies who take decisions don't want the matters to reach courts later. They want to have probably an inclination of what the government is thinking much before they get into some sort of structure for their employees or their companies. So days spent searching. So basically Bharat Gas basically said that deputation or secondment is for the purpose of your employment only. Again, courts might get into the fact of is it permanent or on a semi-permanent basis. So that one probably issue might even come up in a deputation or a secondment, which will have to be taken care of. Now in a recent decision, which is Videsh Vijay Gulati, the Mumbai Tribunal, has very interestingly said that let's say you go outside India looking for a job. Even the period you have spent looking for a job can be excluded, other than the period which is there. So basically, the extract says that the SSC claimed that he went to the USA to seek employment. Basically, in the fact pattern here, the SSC had spent 28 days looking for a job. And the assessing officer said, I am not going to allow you the benefit of that 28 days. Whereas the tribunal said that he went to USA to seek employment but could not get succeeded. The SSC has claimed that going outside India for the purpose of employment does not mean that the actual services have to be rendered for employment. But if somebody goes outside India for the purpose of searching employment, same can be construed as for the purpose of employment outside India. So here, probably the courts are going a little more leniently towards people who are actually going out looking for a job. But in this case law, it is also interesting to note that facts to the tune of the 28 days that actually spent looking for a job have not come on record. But probably it was the lower authority who have already seen that issue, and therefore I think the tribunal did not raise an issue on the validity of how we spent the 28 days in the US. Now, we'll just take a short break here. Any doubts here before we move ahead? Now, because we'll move into deemed residency. Any doubts, or we can move forward? Okay, we'll move ahead. Now, Section 6(7) of the Income Tax Act, which is the erstwhile Section 6(1), deals with deemed residency. I just read out the section very quickly. Irrespective of the provisions of Sections 2 to 6, an individual shall be deemed to be a resident in India for the tax year if he is a citizen of India, first requirement. Second, he is not liable to tax in any other country or territory due to his domicile, residence or similar criteria. Now, what is the meaning of similar criteria is the first question which will come up in our minds. So basically, domicile, residence and similar criteria. Therefore, using the principle of adjunct generis, that is basically a word has to take meaning from the earlier words which have been used in the section. So domicile, residence being used, similar criteria has to mean something on the same lines. It cannot be something which is far away from the meaning of domicile or residence. So basically, they have attached a sense of locality to the word similar criteria. The third being again the income condition, where it states total income exceeding 15 lakh rupees during such year, other than income from foreign sources. Now, the memorandum of the finance bill, which brought this into the act, stated that the section was introduced to tackle the issue of high net worth individuals choosing to stay non-resident in a couple of jurisdictions. So basically, they loosely term this word as a stateless person. Basically, somebody who's not a resident in any state. So they wanted to combat this situation where a high net worth individual, due to his means, was able to hop countries and not be a resident in any of those countries. This was causing a double non-taxation in the country of source as well as in the other countries. So therefore, to make sure that that does not happen, and also in the global scenario right now, which is closing all the avenues slowly with respect to treaty shopping and double non-taxation, it was necessary for the authorities to get this into the act. Thereafter, there was a huge hue and cry with respect to all the workers in the UAE. We said that these people are working in the UAE where there is no tax. Now please don't tell me that now you are going to say you are a resident in India, so you pay taxes here of what you earned in the UAE. Then the press release said that this is more of an anti-abuse provision. We want to make sure that people are not on purpose shifting themselves to either low tax jurisdiction or no tax jurisdictions. You are not doing this by design. It is by default that you are there in some country and you are earning your income there, and this will not affect people who are going there with an intention of actually work and not with an intention of not paying taxes. So that was then stated by the government. So this is an anti-abuse provision to deter Indian citizens from shifting their base to a low or no tax jurisdiction to avoid the payment of tax. That is the press release which was released February 2nd, 2020. Now just going into the specifics of the section, like you read earlier, 6.7 applies to a citizen of India. Now who is a citizen of India has not been defined in the act. So therefore it is important to us to first know who is a citizen of India. Citizenship now currently in India can be acquired in 3, 4, 5, 6, 7, 5 modes. First by birth, second by descent, third by registration, fourth by naturalization. That is, you stay in this country for a certain period, you invest a certain amount, you naturally become a resident of that country because of your stay in the country. One of the examples for naturalization I can say is Adnan Sami. He's a famous singer who stayed in India for a number of years together. Then he was awarded as being a citizen of India by means of naturalization. That you are naturally, it seems like you want to stay here, and we see prima facie that you are not going to be a problem to this country, therefore we wish to offer your citizenship to this country. So that is naturalization. Incorporation is basically for any other entity other than an individual. You can become a citizen of India by incorporation. Now, however, an overseas citizen of India is not a citizen of India. This is a specific carve out in the Citizenship Act of 1955. It says an OCI card holder can enjoy multiple benefits. Basically, he can enter India, exit India without any visa requirements. So basically, he has a free entry and exit from India anytime he wants. But he does not get the benefit of, let's say, voting. He cannot stand for a public office. He cannot stand in elections. He cannot be a member of the parliament. So there are a couple of conditions which certain powers which are not there with the OCI holder. And because these powers are not there with him, he cannot be considered as a citizen of India. Hence, the section 6.1a cannot apply to a OCI card holder. Now, coming to clause B. Now, liability to tax. Liability to tax, this phrase has been under interpretation for a very long time. Earlier, this term was not defined in the Act. I think after the controversy erupted, the government decided that it is better to define this term rather than fight this in the courts. So what they did was, they defined this, that means that there is an income tax liability on such person under the law of that country for the time being in force, and shall include a person who has subsequently been exempted from such liability under the law of the Act. Now let's say a person ideally is taxable in India for any income he earns. What the government has then done is saying up to 4 lakhs I will not levy any tax on you. So basically, first of all, there is a tax liability on the person, but thereafter that has been exempted from any liability due to the, let's say, whatever the government wants to do with the fiscal policy, this thing, 4 lakhs I will not levy tax. But in that scenario, you can clearly say that that person is liable to tax. Now there are two phrases which generally come up in a discussion when we discuss liability to tax. There is something also called as subject to tax. Now there is definitely a difference between liable to tax and subject to tax. Liable to tax, like it's defined here, is enough if there was a liability on you which may later get exempt is a different question. So basically the Supreme Court in Azadi Bachao, which has basically been, I think, a landmark decision with respect to a lot of international tax matters, with respect to the interpretation of DTAs, etc., has stated that liability to tax is a legal situation. Subject to tax basically is only a fiscal fact. Basically, subject to tax is the proof that you have paid tax which was liable on you. So that is the only meaning of subject to tax. So they are saying the right of taxation is first important. The payment of tax is just a fact that okay, you are liable and you have paid it, and there is no need for any further introspection whether you are liable to tax or not. So basically what we can state is subject to tax is probably more narrower than liable to tax. Liable to tax is a bigger basket. Subject to tax would fall within that basket for just ease of understanding. Now subsequently this decision of Azadi Bachao was followed by Green Emirate Shipping and Emir Rafiq's case again in an ARR. It was held that wherein the right to tax is available with the other contracting state, and it is its prerogative to exercise, that's the same. So basically today, let's say UAE does not have tax on individuals, but it has already introduced certain corporate tax and also tax for individuals who are engaged in business are still liable to pay tax in the UAE. So basically now they have exercised their right which they always had. Now bring within their ambit people, individuals also who will now have to pay tax. So basically this is the right which they are always talking about in the earlier decisions. But however, there are a couple of decisions in Cyril Eugene Pereira and also in Abdul Razak Memon which stated that the argument the relief has to be granted on the basis of potential tax that can be levied sometime in the future does not hold good, because I don't know when this is going to happen. And also when let's say the DTA was entered into between UAE and the India, it was very well known that UAE did not have any sort of taxation at that point of time. So basically in this case, the honorable bench of the era was of the opinion of why were there even clauses introduced into the DTA which dealt with taxation, basically independent personal services, dependent person. Why were they at all there? Because at the time of printing there was no tax, there was no requirement for those clauses to be in the DTA, and this could have been introduced once there was a specific taxation that was introduced within the UAE regime itself. So basically they also came from the fact of tax avoidance to state that it cannot be a case that there is double non-taxation in both countries. You are not taxable in India as well as you are not taxable in the other country as well. Now recently I think we've seen a number of cases where double non-taxation has been blessed by the courts itself. It is the decisions by a number of Mumbai tribunal decisions which have held that the sale of mutual funds by a citizen in the Middle East is not taxable because they are not shares as per the DTA. So basically they are not being taxed within the Indian system as well, and they have also escaped tax within the UAE system. So basically even though, and they said that the basic crux of entering into a DTA was to avoid any sort of double taxation, but it was not to encourage any sort of non-taxation within both the countries. Now it might so happen that non-taxation, double non-taxation is happening not by choice, it's happening because certain circumstances just take place where non-taxation happens. But here something like a residency can basically be arranged in a sort of way that you avoid taxation in both countries. Now to basically address this, I think we have a broader issue of GAR now which has come into the act to say that let's say we feel that you have arranged your residency on purpose. What we will do is if we see that the tax benefit is more than 3 crores in a certain year, we can now make you a resident of India. If we see that you have employed a certain structure on purpose to avoid taxation in India by using residence, we will go back and alter the entire structure to say now no, you are not a resident of UAE, you are always a resident of India, you place taxes in India. So basically now a certain portion or color of intention has been infused in the act. Now they don't want only legal arguments to take forth, but there has to be a certain mixture of an intention of being a true taxpayer in the country, and anybody is probably sort of setting up any kind of structure, they are not going to encourage this going forward. Now, the OECD commentary is probably saying something different to what the Indian courts have said. Just if the entity is subject to tax laws of the country, irrespective of whether exemption is granted or not, then it would be treated as liable to tax in that country. So basically, like I told earlier, that subject to tax is a bigger basket. If you are subject to tax, means you are definitely going to be liable to tax. The OECD does not expressly clarify about the future right of the country to levy tax and its relevance to the term liable to tax. So basically, what the Indian courts have held has not found place in any scripture or article or any book till now. It's probably just on basis of interpretation what they have done. Now, these are the precedents which we just discussed briefly. I have tabulated them. Emir Rafiq's case was a favorable case, and Green Emirates and Azadi Bachao basically all said the same thing. There is a future potential liability for taxation. Therefore, what we will say is you will get the benefit. I have taken, for example, in India, UADT benefit. You are going to get benefit in all these countries. I think now, going ahead, I think a better example would be, let's say, Qatar or Kuwait, because they still don't have any sort of taxes on income. They probably have VAT, but it's also just increased very recently. So there are no taxes in Qatar or Kuwait. So in those countries, I think still you can use the principle of saying that there is a future liability to tax. Therefore, I am liable to tax in that country. I cannot be made a deemed resident in India. Basically, Cyril Pereira and Abdul Razak Menon are the only two decisions which are against this. No. Clause C is basically again just giving us a monetary limit to state that if your incomes of other than foreign income is basically more than 15 lakh rupees, we are going to treat you as a deemed resident. Other than foreign income has been defined as income which accrues or arises outside India, except income derived from a business controlled in or a profession setup and which is not deemed to accrue or arise in India. No. Before we get into this, certain questions arise. Now, can we state that was there any requirement also for a 618 to be implemented into the Act? Because there are provisions of Section 9 which are already in place, which state that any resident or any person who earns any income from India is liable to tax in India for that income. And basically what 61A is doing is making you an RNOR. The ambit of the RNOR is generally limited to something which is incomes which are accrued or arising in India are only going to be taxed as an RNOR. There is an additional limit which says money is received in or deemed to be received in India. According to me, that also has to be read with some sort of an accrual in India. There has to be some territorial nexus. Just because you accrued something as accrued outside India and you received it in India cannot make it taxable in India for an RNOR. It is understandable that for a resident world income is taxable. But for an RNOR and for a non-resident, only incomes accruing or arising out of the Indian subcontinent can be brought to tax. Therefore, when Section 9 had already was in place to probably address this issue, was 61A even required? And also 61A probably is applicable to a very small set of people. I don't even think it's 1%, less than 0.1%. Who are it going to be applicable, where basically the government can make one argument for the requirement of 61A in the Act is probably you will not be eligible to any treaty benefits of any country. So let's say I have become a deemed resident here. There are a majority of treaties which state that a person who is receiving only locally sourced income is not a resident for the DTA purpose at all. So basically even they recognize that you have to have some sort of a connection with the country to be taxable. So therefore the only argument that the government can have is 61A will help you, will avoid any sort of a treaty benefit to the person who is a deemed resident. No. Just reading I'll come to the portion which I was just stating. This is the normal text of 4.1 as per the OECD model commentary. So it means a person who under the laws of the state is liable to tax therein by reason of domicile, residence or any other criteria. This is very much the words which have been used in 6.7. Then there is Article 4.2 generally which is a tiebreaker for individuals. Basically a tiebreaker is somewhere where a person is resident in India as well as is a resident of another country as well. So let's say basically you are resident in India for 120 days and you stay in UAE for 180 days. Then there is a requirement of a tiebreaker rule where you see a number of conditions to then arrive at to say that the individual was a resident of which country. Something like a permanent home, central or vital interest, where your family is, where are you doing your business, where do you reside more permanently, those sort of citizen, your citizenship, your nationality. Those are the factors which are considered. Now, like I said, if you read the blue portion here, now this blue portion is available in a lot of DTAs. Basically, it's available in the UK, Kuwait, Qatar, basically a lot of the Middle Eastern countries, Cyprus is a tax haven. All of this will have this. They say this term, however, does not include any person who is liable to tax in India in respect only of income from sources in India. Now, if you read the last bit of 613, which says he has to have income other than foreign sources, which means to say it has to be only Indian sourced income. So basically, somebody who has now become 618 under the Act will never get into the treaty. He is escaping the treaty by not becoming a resident of India at all. So he will say, I am a resident in the UAE. I am not a resident in India at all. So basically, as per the India-UAE treaty, I am taxable only in the UAE. Therefore, what has happened by introduction of this section is probably some people will actually escape taxation in India and go to another country and be taxed. According to me, 618 was purely for people who did not have any base. Basically, who were absolutely not staying in any place for more than, let's say, 60 or 100 days at a go. So only for those people, that's why I said it is probably applicable to a very minuscule percentage of the 10 crore taxpayers who are there in India. Now, it is required now that because 6.7 now uses certain terms like domicile, residence and other similar criteria, it is now probably important to understand why these words have been used. Now, it is not merely enough if a person is liable to tax in a certain country. It is important that the liability must arise on account by reason of domicile, residence or any other criteria. So basically there has to be a real and live connection or nexus with the country. So basically only liable to tax, the department cannot tomorrow come and tell that only you are liable to tax, but you has to satisfy the other connecting factors that are also there in 6.7 for you to be called a deemed resident. The fulcrum of this section basically lies in identifying the attachment to a country or territory that enables a jurisdiction to enforce its taxing powers. That is important. Now, the criteria that establish the jurisdiction link or an access to a person has in the country. So here Professor Crossover defines connecting factors as a resident criteria of domestic law that attract taxation applicable to a person specifically connected with the state of taxation. These criteria have been defined as locally related. Basically it is, let's say for an example, it is merely not enough if you are a citizen of a country. You should have some real connection with the country as well. Going forward I will probably give out some case laws which have been held in foreign jurisdiction which clearly have stated that merely being a citizen is not enough. They have denied benefits to somebody who is merely a resident and who does not have any real connection with the country. Now, two interpretations of this phrase are possible. One, territorial connection, which is the more narrower interpretation to state that you should have just a local connection is enough. Whereas a functional connection is, let's say, one of the factors is making your worldwide income taxable. Can such a wider interpretation be taken at all? Now, should this face other similar criteria be interpreted in a narrow or a wide manner? Basically, most of the commentaries around the world who have interpreted DTAs, because this has been borrowed from the DTA, the 6.7, all of them have held that a narrow interpretation is in line with what 6.1a wants to achieve. But as we read that the press release clearly stated that it is an anti-abuse provision. So the government can go ahead with the argument that because it is an anti-abuse provision, we will read it as widely as possible. So the smallest of factors can therefore make you a deemed resident. Now, there was one case law which has happened, which was probably adjudged by the Bombay High Court, where what happened was an individual was a partner in a German LLP. So basically for the German tax law, an LLP is a transparent person. So basically the LLP is not the person who is taxed, it is the person who is ideally taxed in Germany. So what this individual did is by filing the returns in India, it claimed that tax which was paid by the LLP as credit. Saying that, look, this is an LLP which is already registered in Germany, I have paid taxes also in Germany, so ideally I should be allowed to claim the credit of these taxes in my individual return as well. And the ITAT went ahead and accepted this argument of the SSC. Bombay High Court did not delve into this issue and merely stated that look, the ITAT has already, the fact finding has been done and they have stated this a resident, so we will not go into it. But basically here, what probably was not taken into the fold by the Bombay High Court was every other entity which is registered in Germany pays this tax. But here if you see the person as an individual has absolutely no connection with Germany. It is the LLP which is doing the business there on its own. Only merely because it paid taxes there can he make a case that I am going to claim taxes for this. This in the future is possible that Germany will say I will not give you credit for these taxes because you don't have any real connection with this country. It is the LLP which has a connection in this country. You do not have any connection. It might be a possibility that going ahead because of MLI and all the other things which are now trying to tie a stricter noose against people who are trying to misuse the DTAs, can then say that sorry, I don't think you have any connection with the country. I require that connection to be there, hence I am not going to give the benefit. Now, like I said earlier, can acquiring citizenship of another country through marriage, etc., or can a transient residency establish residential status? Now, for example, there was a case law in Portugal. So basically, what happened was a taxpayer married somebody who was a resident in Portugal. Was a citizen of Portugal, but he was a resident in Germany. So at the time of paying taxes, what it told was that I will invoke the Portugal-German treaty and I want to be resident in Portugal. Probably there was a beneficial provision in Portugal. What the court said in Portugal, that your real and life connection is not existing in the present place. That you have only acquired a citizenship in Portugal basis your marriage, because there is a law, local law, which says that if one of your spouses is a resident of Portugal, on marriage even you will acquire that status. So the taxpayer acquired the citizenship of Portugal because of marriage. But the court denied any sort of treaty benefit by saying, sorry, we don't see any kind of a real relationship. We don't see a sufficient link between you and Portugal. Therefore, we are not going to give a DTA benefit. Probably this is something going ahead in time, you will see a lot of decisions like this. Similar thing can happen in the US as well. Once you get married to somebody who is a citizen of US, you also acquire citizenship. But there is a connecting factor in the DTA itself. Saying citizen itself is a connecting factor. So where US has specifically stated that a citizen is also going to be a resident of my country, then I think a taxpayer has a strong case to say, no, I am a resident of US and not in India. Now this is just a tabulation of basically all the GCC countries. So basically I was talking about Qatar, Kuwait, Saudi, Bahrain, Oman. So basically what we discussed in the last 20 minutes relating to the deemed residency, which is basically are they liable under the domestic laws of that country, and what is the condition in the 4.1 provision that is in the DTA. 4.1 basically deals with the residency in the DTA. Now UAE is not liable to tax. Now there are certain reasons why I am saying, we'll go ahead and probably see why I am saying that there is no liability to tax under domestic law in the UAE. And basically you can still access the DTA if you are crossing 183 days in the UAE. If you are 183 days in the UAE, you can become a resident in UAE. Even if 618 is applied, you can come out of 618 saying you are a resident in UAE, then use the treaty to your benefit. Saudi liable to tax, yes. Currently there is no impact, probably there is going to be a tiebreaker test. In the tiebreaker test, whichever side trumps, you will then have to pay taxes in those countries. Kuwait, Bahrain, there is no liability to tax domestically. Again in Kuwait there is a 183 day stay condition. Basically you can again use that and come out of deemed residency. Bahrain, there is no tax anywhere, so you basically are going to be NOR for all practical purposes because there is no liability to tax. Then Oman and Kuwait, again going by the intention that future taxes are possible, you might say that there is a liability for tax. And then liability to tax condition again is there in 4.1a, that is the source one. There is no impact here with respect to the DTAs. Basically again a tiebreaker will decide you are a resident of which country. We will take up just a small case study on this matter. Now Mrs. SL, an Indian citizen, is employed in Dubai, UAE. Her family also lives in Dubai. She visits India yearly for 30 days. She has income of 2 lakhs per month for renting out a property in Mumbai. Mrs. SL wants to know her implications under section 6.1a, which is section 6.7 now. If she is deemed a resident, whether she can take recourse to India UAE treaty at all. Will it make a difference if Ms. SL was employed in Bahrain instead of Dubai? No. First, we have to tick off all the conditions which are there in section 6.7. First, the easier condition to tick off is whether the income is more than 15 lakhs in India, yes. There is 2 lakhs a month, multiplied by 12 months is 24 lakhs. So the first 15 lakhs condition is satisfied. Second, is she a citizen of India? Yes, very much she is a citizen of India. She moved to Dubai for her work. Then, so first to citizen. Then, but as per the federal decree law, which is basically the UAE law relating to individual taxes or corporate taxes, since a natural person having only salary income is not under the scope of levy of tax at all. Basically, that is will not be regarded as a taxable person. It is only somebody, an individual who has business income is taxable in the UAE. So basically, a resident is defined in Article 11.3c of the Federal Decree Law of the UAE law. It says the term resident only means a natural person who conducts business in UAE. So basically, every other person is not conducting business in UAE, is not even a resident of that country, as per their own law. So therefore, can I therefore say that a person is not liable to tax at all in UAE by reason of his domicile or residence? That argument can be taken that he is not a resident there, not a resident. So what happens is then 6.1a will come into play, saying you are not liable in UAE because of your domicile, and you please pay taxes in India. So there is one risk that is there to her here. But what happens if she shifts to Bahrain? Bahrain does not have any sort of such restriction in its DTA. So probably if she is a resident of Bahrain, she will be able to enjoy her treaty benefits. I think we are coming closer to 6:30. Yes. I will probably just take another 5 to 10 minutes to wrap up. Yeah. Now, this is one of the latest concepts now that has creeped in due to the movement of people between countries. Now, which is also happening quite frequently, because now let's say somebody is staying 6 months in the UAE, stays or 8 months in the UAE, stays 6 months in India. So there's something called a split residency now which has come into existence. This has also been vouched by the courts now. This is nowhere written in any law. How do you deal with the situation of split residency? It is a court-made law. It is not there in the DTS, it is not there in the Income Tax Act. So basically, criteria has to be considered for tiebreaker, like I said earlier. Existence of a permanent home, central of vital economic interest, where is your habitual abode is basically where you stay regularly, what is your nationality or what is your citizenship. So basically, let's say you are a citizen in both countries, you have to go down factor by factor. If let's say you have a permanent home in both countries, then we move to the next factor, that is where your economic interest. Let's say your wife stays in Dubai, your children stay in India, or your parents and your children stay in India, or wife stays with you in Dubai. Now there is equal economic or vital interests lying in both countries. You might have businesses in India as well as you might have businesses in Dubai. So I think that is divided. Then you come to habitual abode. Let's say you stay in both countries for 6 months. So all these 3 conditions are now gone. Fourth, nationality. Now it is possible that you are a national of India and you can acquire nationality of Dubai through investments, let's say a golden visa or something of that sort. So even that is possible. They have envisaged that you can be a national of 2 countries. Being a citizen and being a national are different things. So nationalization can still happen. So let's say all these fails, then last thing that is going to happen is a mutual agreement procedure, which is a map. Where both departments from both countries will sit across the table and say, I think he's inclining more towards India, or the UAE will say, no, I think he's inclining more towards UAE. And then after that agreement procedure, the residency will be decided. By virtue of the applying the breaker rule, if a person becomes resident of one contracting state for part of a year and a resident of another contract state in another half, what would the implications be? This is basically split residency. Split residency is basically a carve out from dual residency. Dual residency is where he is a resident in probably, let's say, in entirety of years. Calendar year also he is completely a resident, and he is also a resident in a financial year. In India is a financial year resident. In Dubai they follow a Gregorian calendar, which is January to December. He is a resident in that country also. That is a dual residency case. But a split residency is, let's say you are in India for 182 days and you are not in India, you are a resident in another country for, let's say, the rest of the period. 130 you are in India. The rest is another 230. another 230 in another country. So basically all these decisions which are there, I've heard that you have to be taxed only for your incomes earned in India. Now this is something new in the Indian jurisprudence which is coming about. That they are giving this benefit of a split residency. Saying, okay, I understand you're a resident of another country for so much period. You have been employed, let's say, in the US for these many days. You please pay tax on whatever income you have earned there. Whenever you came back to India, you pay tax on whatever you have earned in India. Is what these case laws have held. Basically, the Nitesh Vijay Gulati, which I just discussed some time back, has also stated that he should only be taxable for what he earned in India, not what is earned in the US. Samir Malhotra, Raman Chopra, Kumar Sanjeev Ranjan, all of these have in one way or the other dealt with this concept of split residency. Now this, like I told earlier, is derived from dual residency concept, but recognizes that the individual's tax residency can be split into two different periods within the same year for each country. That is basically split residency. Now, the basic difference between dual and split residency, time period. Dual residency, like I discussed earlier, it is full tax years where you are a resident. Split is different parts of the same year you are a resident in two countries. Recognition in India recognized, resolved by DTA tiebreaker rules, dual residency. Split residency not recognized under Indian domestic law, it is recognized under DTS. There is no recognition entirely anywhere. This is probably a very, very lenient reading of the Act for somebody who is a resident in two countries. It is probably adopted when somebody does not want to go for a map. Taxation, single residence determination, global income tax accordingly. Taxation split by residency period, like I told earlier. Let's say you earned some income in US, you will be taxed there for your US income. And let's say you are a resident for India for a certain portion, only Indian taxes will apply for that period. Practical context applies to individuals with overlapping full year residence status. Split residency applies to individuals migrating or relocating mid-year. That is where the problem generally arises. Now, when in the first slide we read something, the second one was Center of Vital Economic Interest. Now this term has also been or has seen some litigation recently in a couple of years as to what actually can constitute a Center of Vital Economic Interest. Now recent tribunal rulings in India emphasize that the determination of Center of Vital Interest under the DTA is intensely factual and hinges on a holistic evaluation of both personal and economic ties to India versus other treaty country. The findings of the following judicial precedents are notable. Basically, Ashok Kumar Pandey, Mumbai Tribunal being the most recent one, Samir Malhotra and Kumar Sanjeev Ranjan being the earlier decisions. So basically, just some background on Ashok Kumar Pandey, which is a recent decision. It states that basically in this scenario, Ashok Kumar Pandey was a resident in the UAE as well as a resident in India. Then they went through all those four factors which were there, which is the tiebreaker rule was applied. The permanent home, he had two permanent homes. Then they came to Center of Vital Interest, where he had incomes in both countries, but he had more sort of passive incomes in the UAE. He had incomes from rentals and investments in the UAE, whereas he was actively managing a private limited company in India. And also all his close relatives were in India, basically his family, his children were in India. So what the court then said was, we have to see where you have a more active connection. That will be your center of all your vital interests. And therefore they held India to be the center of the residence of the individual. I think we've come to the end of probably what I had to share. If there's something anybody would like to discuss or any issues, we can take it up now. Okay. So just close my presentation by saying that the important thing is to not stop questioning. Curiosity has its own reason for existing. A nice quote from Albert Einstein. So I think in the profession we are, I think it's mandatory to keep questioning on a daily basis to know more. So I think the conquest or the quest for all of us should be this going ahead. So thank you so much. I'd like to thank the entire SIRC community for inviting me and also all of you for a very patient hearing. Thank you so much. Thank you.
Welcome back, members. We have this second technical session. So the speaker is Hanish. Yes. Request chairman to escort the speaker. Yes. And please listen to the floor. Members, it's a pleasure to introduce the speaker, which is the very shortest form of introduction that Hanish has given us. So Hanish is a partner of CLK, HSKA and Associates LLP and heads the GST litigation practice. The firm is a part of CLK network, having 10 plus office across Bangalore with a team size of more than 1,000 people collectively. Hanish has represented clients before various forms including SESTAT and Advanced Ruling Authority. He is an active speaker on various impactful platforms like ICI, ICSI, Bombay Chartered Accountants Society, Chamber of Tax Consultants, etc. That's the shortest one. So the floor is yours, sir. You can take. I have an announcement. Tomorrow we have a tax audit seminar, two-day seminar. That's National College. If you are not registered, please register for it. And that's it. And please communicate with your friends as well. Thank you.
Good evening, everyone. Good evening, everyone.
Good evening.
I generally like the sessions to be interactive, so you will have to keep responding. When I say interactive, you cannot ask me questions. I'll keep asking you questions, right? We have got a very interesting topic which is being given, very unique topic. Now, after GST has come, this kind of topic has never come up at all. Or maybe every 2 months we have same topic only. Every 2 months there is recent update in GST because that many times GST has been amended, right? We are going to focus on the last GST Council meeting, that is the 56th GST Council meeting. But why is it relevant? Because the Lakshman Rekha or the date was 22nd of September and everything which was required to be done has already been done. So why are we even talking about that? The reason we are going to talk about that and why we thought this is really important is because the first return after 22nd September is going to be this return where you have to give impact to whatever changes were required to be done. So that's why I thought it is really very important to look at those. So we look at those recent changes based on GST 2.0. But before we start, I would like to thank the Bangalore branch for allowing me to come before you and share my views on GST. Also, I would like to thank Nithin, who was the earlier speaker, who suggested that we jointly do this program. So thanks a lot to him as well. I also acknowledge presence of my dear friends who are sitting there as co-speakers. Actually, Venu could have been a speaker here, but he's kind enough to sit as a participant. He said whatever questions which are difficult questions you are not able to answer, I will be answering those questions. So thank you very much for that. Right. But any assignment comes out of these, you please take is what. Thank you very much. Right. Okay. Right. So first we look at change in rate of taxes. Okay, very basic, high level, because when we talk about goods, it's very specific whether you fall into that goods or not. That is what will decide. But the important aspect here is that majority of the rates, majority of the goods or services which were at 12% has either moved to 5% or has moved to 18%. So basically we don't have a 12% rate of tax. While popularly everybody is saying that there are only two rates of taxes, which is 5% and 18%, which is majorly true because almost all the products are under those rates. But we still have 28%, we have 40%. For diamonds, for gold, we have lower rate of tax. For merchant exports, we have 0.1% tax. So still there are other rates of taxes which are still available. Somebody was asking me the break whether compensation cess is still there. It is still there, right? But what they are trying to say is that majority of the goods which we directly deal with on a daily basis have been moved either to 5% or 18%. That is what is the objective of saying that we have only two rates of taxes. right? Okay. Now, will this change in rate of tax impact the final price to the customer? See, I was under 12%, that's got moved to 5%, or I was under 18%, that's got moved to 5%. Will it have an impact on the price which the end customer pays? Of course, yes. While there were guidelines which were issued to ensure that implementation is smooth, and they said you don't have to send back the goods to the manufacturer to change the MRP. But you would have seen in a lot of places, especially if you go to textile shops, ready-made garments, earlier the distinction was below 1,000 rupees and above 1,000 rupees. Now it has become less than 2,500 rupees garment, the rate of tax is 5%. More than 2,500 rupees garment, it has become 18%. So if you go to any ready-made store, there will be a big banner outside which said before this was the rate, new rate is so and so. Also, if you go to a lot of these dry fruit stores, I'm sure festival season is coming, so you might be visiting or you might be forced to visit. You would have seen a lot of banners there where they have said earlier the rate of tax was X, now the value of product is X, now it is reduced to so and so because of rate reduction, right? As well as cars. I'm really sorry, very important discussion you might be having, but I get a little distracted, I'm sorry for that, right? Okay. So even cars, you would have seen the rate of tax, when somebody would be surprised to say that 28% rate of tax has actually become 40%. How are cars cheaper? The effective rate of tax on cars, including compensation cess, was really very high. Okay, in some of the cars it was coming to as high as 50%, because 28% was the base rate and 22% was the compensation cess. That's got reduced to an effective rate of 40%. So we are talking about a 10% discount. So it's not a Diwali discount which you are getting on a car sale purchase. You are getting a GST discount, right? And I'm not sure if you've read that news. Mercedes sold highest number of cars in the last 1 month. My memory fails me, but every day they have sold like 9 or 10 Mercedes after the rate reduction has been announced, right? So effectively the rate of tax has come down. MRP has not changed because government relaxed the rules, but communication had to go to the customer that we have effectively reduced the rate because of rate reduction in GST, right? What will happen now? Till the December, the car will be available at a lesser rate. January, the new chassis number, the year will change, and so the prices will increase. Maybe, I'm not sure, but competition will take care of all of that. Okay. So one of our customers, real estate customer, client of ours, they got an email from their client who had purchased the apartment saying that I've been following the GST council for quite some time. The recommendation says the rate of cement has reduced from 28% to 18%, and stones also, some of the specific stones, the rate of tax has reduced from 28% to 18%. In fact, in some of the cases, 18% has got reduced to 5%, right? So I have agreed for a price of 10,000 rupees plus GST. Now please tell me what is the discount you are going to pass on to me. It's the mail which we got for one of our real estate clients just 2 days after the GST recommendations were circulated in all the WhatsApp groups. What do you think? Should the real estate developer, should reduce the rate of tax on apartments for the existing contracts or no? We'll come to new contracts a little later, but for the existing contracts, right, where the rate of cement is reduced from 28% to 18%, what do you think? Should? Not required? We'll have to answer. The door is closed now. Only when we all decide we have to go, only then the door will be opened. Right? What do you think? Sorry? No change?
No, it should change.
It should change. Why is that? Because 10% effectively will change, and it was a no input tax regime. So 10% whatever you were paying to your vendor additionally has effectively reduced your cost, right? So 10% reduction to the extent of cement component should be so 10,000 should at least become 9,800, right? Okay. Anything else? Now here it becomes really very, while I believe that the rates should reduce because the works contract after 1/4/2019 is liable to tax at the rate of 5% without input tax credit. The developer cannot claim that earlier 28% I was claiming credit, now 18% I am claiming credit, so it was never part of my cost. and so I'm not required to reduce the rate of tax. That may not be true, especially in works contract. But the point is, we'll have to see the procurement pattern also of our client. Okay. In our case, the client which I am talking about would never buy cement. He always buys RMC, or he has RMC plants itself by his contractor or contractor, where the rate of tax itself was 18%. While cement was at 28, RMC was always at 18%. So you have to also understand the procurement pattern of the customer before deciding whether the rate of tax will have an impact on the final price or not. Second justification which we were able to get was that while we have fixed the price, if you see in the last 1.5 year, the rate of cement itself has increased by 8 to 10%. So we have not come back to you with the increase in the cement price. And third, when we talk about change in rate of tax on stones, blocks rate has changed, but slab the rate of tax still remains the same. Right? So while blocks rate of tax is reduced to 5%, slab is at 18%. And what we give you, first of all, there's no granite which is given in this project. By mistake also, if instead of tiles we are going to install granite for you, the granite still remains at 18% only, so there's no change in rate of tax. So the next day we got another call from one of the, and I hope I'll tell the institute to cut this part when this video is getting uploaded. So one of the other clients called and said, look, we are selling granite, the rate of tax is 18% and it all goes to end customer. So let me do one thing, I will sell blocks to all my customer. I will sell blocks to all my customer. What will be the rate of tax? 5%, because blocks is 5%. All of them will give that to me on job work basis to convert blocks into slab. For that job working charges, I will charge tax at the rate of 18%. Is it okay? I am not sure if that is okay, but that's what was the suggestion which came from the businessman. So when we think that we can do structuring, in fact clients will do better structuring than us, right? Third, is there a change in rate of tax on aerated drinks? Earlier it was 28% plus 12%, which is cess. Now the base rate itself is 40%, right? Which effectively means, see, yesterday you were paying, that is 21st of September, you were paying 28% tax and 12% cess on your selling price, and you were claiming input credit of 28% plus 12%, both. Right? Because you had the input in cess and the output in cess. You had the input of 28% and output in 28%, which is CGST, SGST or IGST. But 22nd September onwards, when you sell the same aerated drinks, you are paying the same tax, but you are paying under the head CGST, SGST or IGST. Your cess is 0. Right? So there is a possibility, meaning there are of course arguments here and there, both the sides, but what happens to the cess component? Now that is what happened even in case of cars, right? So closing stock of cess, closing stock of tax paid on the, I rephrase it. The closing stock of car, okay, on which you have already paid the cess, from 22nd September onwards, you are not going to pay an output cess. So is that cess a cost, or is that cess allowed to be adjusted against IGST, because cess anyways goes to the central government only, so it has to be converted to IGST. That debate is still going on. I am told that the Association of Automobiles, that is called FADA, if I am right, Federation of Automobile Association, FADA, something like that, right? Automobile Dealers Association. They have gone to the court, or they are planning to go to the court to say that give me refund of that cess, because what I am dealing in technically is not an exempt commodity. I am still paying tax. Right? When you say exempt, it means that I am not required to pay tax at all, but I am still paying tax. While the other way of looking at this, we have a CGST Act, we have a SGST Act, we have a IGST Act, and we have a compensation cess Act. So if I don't pay any tax in compensation cess, that is an exempt supply, and so I am required to reverse the credit. Right? So the debate is going on. But whenever we are discussing about any industry which suffered cess, and where cess will not be available, this will be one big issue which we have to take care of. Is there a change in rate of tax on tobacco? No, there is no change in rate of tax. That's where I said cess still continues on tobacco and tobacco related products. They will in a future date decide, once the loans have been serviced relating to the amounts which have been lent to the state governments, okay, once the loan and the interest has been paid, they are going to decide when they are going to, delete the entire compensation cess related levy. At that point of time, we will see a change in the rate of tax on tobacco products. But till such time, tobacco products will still be liable to 28% and still be liable to the compensation cess, which was applicable even on 21st of September 2025. Right? So only tobacco and tobacco products currently are leviable to cess. All the other products where cess was applicable, the base rate has increased. Now let's go to input tax credit. Right? Here we have few interesting questions. On purchase of goods, I have paid tax at the rate of 12%. On sale, I need to pay tax at the rate of 5%. Should I reverse the excess 7% or not? No, not required. Sure. These are live practical questions which we got, and that's why I thought it is good that I merge all of this so that we can answer all of these together. So the rate of tax when I purchase was 12, when I am selling it is 5. So have I taken excess 7% credit? No, I have paid 12%. I am claiming input credit of 12%. Now the rate has changed to 5%, but I am not required to reverse the 7% because it's not an excess input what I claimed. I have claimed the input what has been charged to. Right? Okay. Now rate of tax on goods has been reduced to 5%. The goods which I was dealing with, the rate of tax on those goods have been reduced to 5%. Is credit restricted on those goods? No. In fact, in case of certain services, the condition is the rate of tax has been reduced subject to the condition that you are not entitled to input tax credit. But that condition is not there for goods, and hence for goods I am not required to restrict the input tax credit. Right? My goods are exempt from tax. I am talking about goods. We have to be very mindful of whether we are talking about goods, whether we are talking about services. My goods are exempt from tax. So come 22nd of September 2025, my goods which were earlier taxable are now exempt. Should I reverse credit on input services and capital goods or not? Yes? So we have to deal with section 17 and section 18. Okay, we'll come to when section 17 is applicable when we discuss about services. But when we talk about goods, especially taxable goods becoming exempt, we are talking about section 18. Okay. Now, if you look at section 18, all through, be it 18.1, 18.2, maybe say 18.3 is a little different, 18.4, wherever we are talking about, they are only talking about special treatment to input on goods, including capital goods. Right? Whenever they use the word goods, it includes capital goods. Right? They never talk about services. That means if I am dealing in any goods which have become exempt, as far as services have been consumed by me, I am not required to do anything at all. Right? As long as far as I am talking about services, I am not required to give any treatment at all. But as far as goods and capital goods are concerned, what the law says is that if you have closing stock of goods as on 21st of September 2025, you had purchased that or manufactured that and you have claimed input credit on the same, right? To the extent of closing stock, where you are going to pay output tax at 0% because it is exempt, you are required to reverse the credit on input or input contained in semi-finished or finished goods. So, if say suppose you had to manufacture 100 kgs of a product which is exempt and you had manufactured already 1000 kgs. So that means 10% of the total input credit claimed by you for this manufacturing batch, you will have to reverse the same. As far as capital goods is concerned, because it can be used for a long period of time, the underlying assumption in GST is any capital goods will be used for 5 years. Whether you use it for 7 years or 3 years, the underlying assumption is it's going to be used for 5 years. 5 years is 60 tax periods. That means we are talking about any capital goods, say 60,000 is the credit, divide by 60, that means 1,000 is the input credit every month, right? So how much of a period your goods were taxable, you are entitled to claim the credit. But the balance unexpired period of that 5 years, you are required to reverse the credit. And when are you required to reverse the credit? On September 22nd, 2025, for which you will be giving the impact on 20th of October 2025. On the day when all of us will be celebrating Diwali, we will be filing the returns also, computing all these reversals. Clear? Input services, nothing is required to be done. Right? Going forward as well, because I am now in exempt bracket, I will not be entitled to any input tax credit as well. The issue now arises is when I am dealing with taxable commodities also and exempt commodities as well. In that case, I will have to go to section 17 subsection 2. From there, I get routed to rule 42 and rule 43, which says anything specific to a taxable activity, I will get full credit. Anything specific to an exempt activity, I will not get credit. Anything which is for both taxable and exempt purposes. Classic example, our fees. Correct? No statutory audit fees, GST return filing fees, because we are dealing with both taxable as well as exempt commodities or activities. That will be common credit, has to be reversed in the percentage of the exempt turnover divided by the total turnover. Clear? I am not getting into too much of detail of how rule 42 will apply, but that's what is the principle. My services are now liable to tax at 5% without ITC. Should I reverse credit on input services and capital goods? Now this is a question which is of big debate as to which provision will apply. If you go to notification 11 of 2017, which has been amended to give effect to the GST Council meeting, right? The wordings of the notification are X particular category of service, rate of tax is 5% without being eligible for credit on input services, on goods and services, actually the words used are used for providing this service. So any goods or services which you have used for providing this service, even if you would have claimed it earlier, you are not entitled to claim the input tax credit. One line of argument is notification is very clear. Anything used, so let's take an example, right? Any accommodation services provided by me less than 7,500 rupees is now liable to tax at 5% without the benefit of input tax credit, right? Now I have purchased a toilet kit, okay, which consists of say a shaving cream, right, toiletry kit I meant, sorry, and a razor, maybe there is a toothpaste and a toothbrush also, right? I have purchased that. Now on 21st September, I have a stock of all these, how many units are still unconsumed, right? I am issuing that to a room for which I will be charging tax at the rate of 5%. So notification very clearly says goods or services used for providing this service, you are not entitled to claim the credit. So that means the stock of those kits available with me as on 21st of September 2025, I should not be entitled to claim the credit. The second line of argument is, once I have claimed the credit, you cannot question afterwards whether I am entitled to claim the credit or not. In future we will see what has to be done. But whatever I have claimed, you cannot question. So this line of argument is also available. Logically I would think, and maybe a little bit legally as well, that it doesn't make sense, because the moment GST chain is broken, it means input should not be available. While we can argue for the sake of argument and maybe possible we will get a stray decision also in our favor, but I would believe whatever is the stock available with us, which will be used for rendering services on which I am not going to pay taxes, or I am going to pay a lower rate of tax without the benefit of ITC, I am required to reverse credit in respect of the same. And here, why there is a difference between goods and services is, goods exempt, we go to section 18, which does not talk about input services. Services, without the benefit of goods or services, there is an explanation added which says go to explanation 4. Explanation 4 takes us to rule 42. Rule 42 talks about goods as well as services. So when we are talking about services which are exempt or services which are at 5% without the benefit of input tax credit, we will have to give impact to goods as well as services. But when we are talking about goods which are exempt, we have to give impact only on inputs and capital goods. Clear? Now, assuming that I have a hotel, okay, where I provide accommodation services, which is all less than 7,500 only, right? That means 100% of my output tax is liable to tax at 5% without the benefit of input tax credit, right? Okay. Now, in the month of April 2025, I received an invoice. April 2025, I received an invoice. I did not claim input tax credit on the same for whatever reason. I did not get the invoice, I did not make the payment, whatever might be the reason, it did not appear in 2A, but the date of invoice is 1st April 2025. Now, On 1st October 2025, all the conditions of section 16(2) met. I called the GST officer and said, can I claim the credit? He also confirmed you can claim the credit. All conditions satisfied. Can I claim the credit on that invoice on 1st October 2025 when I have moved from 18% with ITC to 5% without ITC? You got the question? Right? Now you have to tell me the answer. Invoice of April, can I claim the credit in October or not? Is this an issue or it's an issue in my head only? It's an issue, right? Okay, then please tell me the answer. Date of invoices? 1st April. We can claim, but the condition is you are not able to claim any credit on goods or services. Used for providing that output service, you will not get the credit. This is claimed in service is used in April already. I have delayed the credit, correct? But that does not mean I will be denied the credit. I will be entitled to claim the credit, correct? Okay. What will I do with that credit? Reverse. Then why to take the credit? Sorry? No, I have only accommodation, 5% without ITC. What to do with that credit? No use. It brings me to the next question. My output is 5% without ITC, right? Can I set this liability against my input tax credit? Let's take another situation, not this situation, okay? I have two business verticals. Business vertical 1 is a startup where I will only make loss, accumulate input credit. Correct? In the same entity, I have another service division, accommodation services, because all my employees are working from home. So my commercial complex I have converted to a hotel, right? Everything less than 7,500 rupees without the benefit of ITC. Two divisions I have. First division, I am generating input tax. Wrong word, generating input tax. I am accumulating input tax. Division 2, I am required to pay output tax. Can I set off division 1 input credit against division 2 output tax? Yes, no? No? Why is that, sir?
Because 5% without ITC.
Without ITC to be availed, not ITC to be utilized. Correct, no? There is a fundamental difference between restriction from availment versus restriction from utilization. Go to works contract entry, it says 5% has to be deposited by cash only. That means everywhere else I can discharge by credit. No sir, officer will not agree. It is his job not to agree. Correct, no? If he agrees with everything, what is he doing in his job? Correct? It is his job to disagree. It is our job to make him convinced. If there is one entry which specifically says you have to pay the entire liability in cash, but that same condition is not there anywhere else. That means restriction is on availment, restriction is not on utilization of some other eligible credit. And that brings us back to the first question. Credit of April of the same business, which is an eligible credit, claimed in October, can be set off against the liability of October, where I am paying tax at the rate of 5% without input tax credit. Do you agree with me? Restaurant services, 5% without ITC. Can I discharge that tax by setting off our input tax against of some other business? Same logic, I believe, I am sure we will be entitled to claim it. We will be able to utilize the credit, but it should be of some other division, because this division of restaurant comes with a restriction of 5% without input tax. Clear? We discussed about cess. Now, what is the meaning of inverted duty structure? Inverted duty structure basically means the rate of tax on input is much higher than the rate of tax on output. Once the rate of taxes have been reduced on output, you will see a lot of cases where there will be an inverted duty structure. So can you claim refund on that or not is a question which we will have to ask for all our clients. Classic name, I have told this a lot of times. Agarbatti is the most beautiful example I can think of. Okay, not because Hema Malini gives advertisements of that. Just generally the fragrance is good, right? The basic ingredient in agarbatti is a chemical compound which is liable to tax at a rate of 18%. But the output tax, which is cycle agarbatti, is liable to tax only at 5%. right? So your input is at 18%, output is at 5%, you will never be able to set off your input against output. You are entitled to claim the input tax rate. You will find a lot of issues around inverted duty structure because of change in rate of tax. But there have been clarifications which have been issued that if the same rate of product, the rate is reduced. So when you bought on 21st September, the rate of tax was 18%. But when you are selling on 23rd of September, the rate of tax is 5%. You cannot claim input tax rate of the same. That circular has been challenged also, right? But to get the refund for that kind of a situation is going to be a little tricky unless you litigate. In other cases where you are accumulating input rate because your input rate of tax is higher than the output, you have a fair chance of claiming the refund. You have a good chance of claiming refunds, right? What do I do with such excess inverted duty structure refund credit? One is check because of change in rate of tax whether you have that accumulation or not. If it is, there will be a slight challenge in getting the refund, though there are High Court favorable judgments. Okay, but if it is because of continuous manufacturing process where the input is itself at a higher rate but the output is at a lower rate, you will get a refund of the same. Right? Quickly, we'll move to time of supply. Very short. I will just take this. You have already figured this out. Okay. Now, when there is a change in rate of tax, right? Section 14 comes into picture, which talks about what is the time of supply. They talk about predominantly 3 events. Okay. But we are talking typically about services. The day when you complete the service, the day when you raise the invoice, or the day when you have received the money. Okay. Any of the 2 events which have happened before 22nd of September, the old rate will apply. Any of the 2 events which have happened, if they have happened after 22nd of September, the new rate will apply. Right? Now, this is very simple 2 out of 3 rule. Okay. Now, just help me out with this. I am again coming to accommodation services only. I checked in on 21st of September 2025. I am checking out on 26th of September 2025. What is the rate of tax the hotel should charge you? And you can think of multiple combinations. Hotel, I will always book in advance. Correct? So I have already made the payment to the hotel on 1st of August. They have already discharged the tax at the rate applicable at that point of time, which was 12%. Right? So now what happens? What should be the rate of tax for a hotel? Is it lower of the 2?
5%.
From a customer angle, lower of the 2. From the advice to be given to the hotel, whichever is earlier, whichever is higher.
Provision of services after 21st.
Sorry?
Provision of services after 21st.
No, I have stayed on 21st night also.
Yeah, for that it is with the
Two events are before or 21st. And 2 events are after 21st.
When do you say service is complete?
26.
On the day when I check out, or every day there is a service which is complete?
It's a continuous service.
It is a continuous supply. That means completion is not there at all, not relevant at all. You cannot say the contract is complete because it's a continuous supply. So what to do then?
Per day.
Per day. I check out at 12 and the next day. Per day concept only is not there in hotel industry, most of the hotels. So that means completion is on 22nd. So 2 out of 3 events in your case will be after 22nd. So it will be new rate of tax. Yes, you said the old rate of tax earlier.
Yeah, old rate on this. If you're charging per day, 7,500 for 2 days.
I am charging per night.
Yeah, that's what, per night.
And checkout is 12 o'clock next day. And the rate is applicable from 12:0001 midnight. And like sir said, there is no completion of service. It is a continuous supply. So I told the client, you don't know what is the answer. Please do one thing. Check out all the customers and then check them in again. He said our software does not allow. If it has to allow, as soon as I say check out, he has to pay me money. Only then check-in will happen. Otherwise check-in will not happen at all. Otherwise I cannot vacate the room at all. For guys who are on SAP, of course. Other guys said, sir, you tell what is to be done, we will do. days we will not raise invoice about it. What do we do? I think the service itself gets completed on the day when there is a checkout. Okay? And the invoice is also being raised on 25th of 26th, whatever date I mentioned at that point of time. And so the new rate will apply, which is 5%. The issue, practical challenge which will come is, I have already paid 12%, but the customer is now saying, please pay 5%. I cannot go back to the customer and say, because of you, I lost the input tax credit. So, GST has reduced, but my base price has increased. Nobody will agree. What to do? Do whatever. If customer comes and complains, give him one dinner free. Oh, matter solved. Correct. But that's what you have to come up with some solution to ensure that the customer is not unhappy. Right? He is happy. He is taken care of because he is aware that the rate of tax from 12% has reduced to 5%. Either you give him a 7% discount and bear the input credit loss, okay? Or second is give him some free services equivalent to 7% and ensure that it is amicably closed. Because there's no, for these commercial transactions, there's no, right, white or black answer. And I skip.
How about if the bookings are done earlier and I have paid?
Okay, let's look at that example also, and let's not look at a borderline example. Let's look at a transaction which is completely, say suppose I have done a booking in August, paid everything in August, 100% advance I have paid, okay? But the service I am going to avail only in November, right? In that case, it's a clear case that the new rate only will apply. Because the moment you do the booking, there is no completion of service. The service is complete the day you offer the room to that person, correct? And he stays there. So completion is taking place after the new rate has come. The invoice is being generated after the new rate has come. The day when you receive the advance, you are actually supposed to give only an advance voucher, and what you get is only a booking voucher. You will never get an invoice. Only when you check out you get the invoice, right? So in that case, though you have collected 12%, okay, you are still required to discharge tax at the rate of 5%. That means you will have an adjustment in your GST returns to the extent of 7%. Your customer will ask you for that refund, and because the rate of tax.
I'm booking directly through the hotel. I'm doing it through the website.
Yeah, Make My Trip or anybody. The point is this advance is going to the hotel only. Make My Trip is only an aggregator.
Sir, but Make My Trip gives me the invoice as soon as I make the payment.
It is only a booking voucher, Nana. And Make My Trip technically cannot give an invoice at all. It can give invoice only for its convenience fee. It cannot give invoice for accommodation because it never runs a hotel. Okay, see, if there are complicated examples also where Make My Trip will go to a popular hotel and say, look, I am buying 100 inventory of 100 units of yours. Tell me what is the rate. They'll pick it up at 5,000 rupees. Year end they will sell the same inventory at 8,000 rupees. What is the HSN now? Is it e-commerce operator or accommodation services? Let's not get into that because that issue is anyways there. Right? We are looking at only recent changes in GST, not the old changes for which we still are struggling for answer. Correct, no? Right. So that issue is still there. But in this case, if the entire advance is going to a hotel and 2 out of 3 events are happening after the new rate of tax, it is the new rate of tax which will apply. Now the issue here is you have paid 12%, there is no proper disclosure in the GST returns on how to show this 7%, right? Second is you will have to give back that 7% to the customer, and you will have to reverse the input tax credit as well, right? So we are doing some math for one of the hotels actually, which has 80% less than 7,500, 20% which is one suite room, which is always at more than 7,500, and during say Diwali or during say New Year, the same rooms are at more than 7,500 rupees. Otherwise the entire year they sell at 5,000 to 6,000 rupees only. Now, if you see the cost of the 5%, 12% has become 5%, for the end customer 7% benefit, you will not believe the input tax credit reversal was actually coming to 6 to 7%. And that is because at that 5,000 rupees also, so okay, I'm sorry, I'll take a step back. So I have rooms available at less than 7,500, I have rooms available at more than 7,500, so that means I have a specified premise, that means my restaurants will operate at 18%. So my rooms are at 5%, but my restaurant is at 18%. On restaurants I can claim credit, On rooms to the extent of 80% of my inventory, I cannot claim the credit. Only 20% of my turnover I can claim credit. But when I offer the rooms which are forming part of 80% at less than 7,500, I am giving breakfast free, for which 5% without ITC. So that means that portion of my restaurant also I am required to reverse the credit. Right? So I will reverse credit exclusively relating to less than 7,500. Right? I will reverse the credit to the extent of breakfast provided to these rooms which are at less than 7,500. The reversal effectively comes to 6 to 7% in the case which I was handling. In some cases it could be more, some cases it could be less. So there is going to be on the final invoice reduction in GST rate, but as far as total pricing is concerned, I don't see a major change, especially for accommodation services. Right? Quickly we will move to the next topic. They introduced something called as local delivery services through e-commerce. What is that? Any idea? Sorry? Excellent, very good. Porter, Dunzo. Dunzo is not there now, right? Okay, that Genie, Swiggy Genie, huh? What is it? Uncle, so all these guys. There was an entry called Goods Transport Agency Services. Okay, there they say Goods Transport Agency liable to tax any other road transportation which is not GTA, which is not postal services, which is not courier services, is not liable to tax. That was the entry, right? So what typically say Dunzo would do, okay, and Dunzo had got a notice from DGA, that's why I am aware of this, is they would say that Mr. A wants to send the goods to Mr. B. I am an aggregator who is mapping 3 people, A, B, and there is one guy who wants to deliver the goods from A to B. Right? He wants to charge 20 rupees. I don't want to charge, I am only a platform. He wants to charge 20 rupees. I will collect it from A, pay it to him. Right? What is he doing? Local delivery, other than GTA. So not liable to GST. I will charge him commission because I gave him business. 25% of whatever he earns, I will charge him commission. So GST is applicable only on that 25% at 18%. So what they did, instead of having a ticket size of 20 rupees on which GST was applicable, they reduced it to 5 rupees by saying I am charging commission. Same thing I am told was happening in Zomato, where this or few other e-commerce platforms, where what they did, the logistics division was a separate company. Right? So you have an e-commerce platform who is involved in buying and selling or connecting for services, and there is a delivery company which undertakes all the delivery. So you will have food charges 100 rupees, restaurant GST and packing charges separately, then you will have delivery charges, right? The delivery charges, if you see carefully in some of the platforms, the invoice was not coming from the main e-commerce operator. It was coming from some other company, and that some other company was claiming exemption from GST on the ground that it is local delivery services other than GTA. Now what government has done is, if these local delivery services are provided through an e-commerce platform, either the e-commerce platform should pay the tax if that guy is not registered, but if that guy is registered, that guy is required to charge GST and collect it from the customer. Right? That's what they have done. Right. Employee car leasing. So whichever employees had got cars and very happy that I have got car. Earlier the rate of tax on leasing of car was equal to the rate of tax on car if I buy the car. So which was 28%. Now the rate of tax on car is how much? 40%. Earlier it was 28% plus cess. Cess was exempt when you provide it as a service. Right? So buy a car 50%, leasing of car 28%. Now leasing of car has increased, is linked to the rate of tax on sale of car, which is 40%. So earlier before 21st September, whoever had got car on lease from their company at 28%, now they are required to pay tax at the rate of 40%. Right? Okay. GTA and rent-a-car, earlier it was 5% without ITC and 12% with the benefit of input tax credit. That has also undergone a change because we effectively don't have a 12% rate itself. So it is 5% without ITC or 18% with the input tax rate. So if you have any clients who are into renting of cars or into GTA, I would think it makes sense to reassess if 18% with ITC is beneficial or not. The reason is, while 12% definitely has gone to 18%, so there is a 6% increase in output tax. But the same car which was earlier available at 28%, we are talking about base rate because compensation says I was not getting credit, will now be available at 40%. So you get a 12% additional input tax credit versus a 6% additional output. And if your customers are B2B, anyways on GTA they are entitled to claim the credit. Rent-a-cab they will not be able to claim the credit, but GTA they are entitled to claim the credit. So please reassess. If you have any clients who are in this space, please reassess whether it makes sense to move from 5% to 18%. Right? Life insurance and health insurance is exempt. It is exempt only for individuals and also family. But it is not applicable for, this exemption is not applicable for group insurance, and they are very clearly defined what you mean by group insurance also, so no playing around that. And if you take any employee insurance, section 17(5) still continues, so you will not get input tax credit also on this, right? Now default rate of tax on job work, Venu sir and I are having discussion. According to him the default rate of tax is 5%. For me residual clause is a default rate, so effectively it was at different rates. So effective rate of the default rate is 18% unless you fall under specific categories. If you fall under specific categories, the specific rate of tax will apply. So if any of our clients or vendors are in job work, please reassess whether the rate of tax what they are charging effective 22nd April 2025 is correct or not. Hospitality sector, we already covered. Most of it we have covered, so I would not want to repeat. This third point I'll come back to it. Okay. Fourth point we already discussed, that we can utilize the input tax credit to discharge this liability of 5%. Another common question which came up was, one of the common question was 5% without ITC means I cannot utilize the input rate. Second is, I am a hotel who is charging 5% to my customer, say Infosys is my customer, I am charging 5%. Can they claim the credit? There is no restriction on the recipient not claiming the credit. The restriction was always on the supplier. The recipient can continue claiming the credit whether you charge 5% or even now 12% or 18%. If the software is not updated, you continue charging 12%, he can still claim the credit on it. Right? So my question, most important question is, after this session we have to go for ice cream. What is the rate of tax on ice creams now? 5%? Input credit available, not available? Not available. Why? There is a very, very funny background story on ice creams. Okay? All the ice cream parlors were paying tax at the rate of 18% with input tax credit on 1st July 2017. Because everybody thought that ice cream is like a restaurant which is serving ice cream, which is a service. So a restaurant, even Adidas was liable to tax at the rate of 18% on 1st July 2017. Right? So even ice cream parlors were paying tax at the rate of 18% with the benefit of input tax rate. Then November 2017, I don't know the exact date, 14th of November, 15th of November, something like that. The restaurant rate of tax reduced from 18% with ITC to 5% without ITC. Right? And only for accommodation services a higher rate of tax was prescribed. So we will not get into it, we will stick to our simple corner house ice cream only. Right? What corner house did? I am a restaurant, everybody is charging 5%, I am also a restaurant, so I will also charge tax at the rate of 5%. So they started charging tax at the rate of 5% without input tax credit. Right? Then came a circular which said, ice cream parlor is not doing anything. It is not providing any service at all. Is it cooking ice cream? Is it preparing ice cream? It is only serving ice cream. Big family tubs, they scoop out the ice cream and give it to you. It is a goods rate of taxes, 18%. So all of you, please pay tax at the rate of 18% with benefit of input tax credit. The entire ice cream industry went to the GST council and said, what is this? We are not able to understand what happens to the past. So a new terminology came in GST, as is various basis. A circular was issued saying, whatever you have done in the past, as is various basis clarified, don't do anything. Right? But from now on, you have to pay tax rate of 18% with ITC, and ice cream is good or bad for health, we are not bothered about that. It is goods. Clear? It is very bad joke. I know. It is goods, right? Now they have changed the rate of tax from 18% to 5% on ice cream, right? And ice cream continues to be goods. So that means it is 5% with the benefit of input tax. I have come across a lot of people who said, no, ice cream is 5% without input tax rate. No, that notion is wrong. Ice cream is still goods, so it will be 5% with the benefit of input tax credit, which means next time you go to ice cream parlor, 13% discount on GST plus input anyways they were claiming, so that they cannot load into your ice cream. Minimum 13% discount. Plus of course on Swiggy and Zomato we keep getting offers. That is another thing. Correct, no? Right. Another important thing, I said I'll come back on that third point which I did not cover. There are certain services which will now be liable to tax the rate of 5% without the benefit of input tax credit. Right? These are hairdressing and barber services, cosmetic treatment. Hospitals also, if they provide any cosmetic treatment, or if salons provide any cosmetic treatment, so Diwali 13% discount, right? Okay. Whether it is plastic surgery or cosmetics or pedicure, manicure, whatever it is called, right? At least I don't get those, not that I don't require, I might maybe, but at least my bike bill has got reduced by 13%, right? Physical well-being services including health club and fitness centers, right, which is basically your gym, okay, and any other beauty treatment. All of these will be liable to tax the rate of 5% without ATC. Now go back to our accommodation services. If there is a hotel which has less than 7,500, more than 7,500, restaurant is at 18% but breakfast is given free, and all these services are typically given by by a hotel. Majority of their turnover is without the benefit of input tax rate, right? Majority. That's why I said that max came up to 6 to 7%, right? So on all these services also the rate of tax is less than is 5% without ATC. 2-3 issues I got in these. I was addressing a few of my clients and came up with very few interesting issues. So a friend of mine, a very dear friend of mine, she's paid me some money to promote her running club. She has a running club in Lal Bagh, okay, where you can go, run, she will train you, okay, it's an academy. Now tell me whether that fee what she collects, 1,000 rupees, is liable to tax at 18% or 5% without ATC. What do you think? 5% without ATC, why is that? Health club and fitness center. There is no center only. Today we will run at tree number 103, near tree number 103. Tomorrow we will run on the second or so of Silk Board flyover because that is not operational. So we will run that place. There is no center at all.
Physical well-being.
Physical well-being. The heading itself is there, and then there is physical well-being. So they train for running 10 kilometers, half marathon, full marathon, 52 kilometers also, right? It is a sport as far as Olympics is concerned. So is it a well-being service or sports training services? Because sports training is still 18%. Well-being is 5% without ATC. And if you go to their website, we will train you for marathon. Nobody will say I am giving running coaching so that you are physically fit. They will say physically fit is by the way, but I am preparing you for marathon. Unfortunately, it will be sports training liable to tax the rate of 18%. Right? Next. So our friend Sanjay is there here. Okay. So Sanjay had a client. He called me and said, my friend is starting a gym. Okay. He's getting AC 28%, dumbbells 18%, 10 kg dumbbells also 18%. 15 kg dumbbells also 18%. What should we do? Should we get all our B2C customers only? Should I get all these with invoice or without invoice? What do I do? He said, please take, you will get full credit of that. Right? Now, gym is ready. Subscription was supposed to start from 1st October. Rate of tax is 5% without ATC. That means all those capital goods which have been purchased, you will have to write off the input tax credit. Just add this, okay? There's another client of Sanjay, okay, who does not have a gym at all. So it is not a center, right? Who does not have a gym at all. If you go on their website, they will send trainers to your house, and those trainers using the equipments available at your house will train you and see whether your posture is correct or not. Generally it is for people who are not able to move outside the house, old people or people who are bedridden or people who have some injuries so they are not able to move outside the house and work out in the gym. So he is an e-commerce platform which will link these kind of customers with the trainers. Now whether the rate of tax is 18% or 5% without ATC. Because again there is no center here. I think here it will get covered like what sir said, physical well-being, and so it will still be liable to tax rate of 18%. That center should not be read as establishment, it is a center. I am a center wherever I am operating from. Right? These are 2-3 interesting queries which we got.
The word is including the word.
Yeah, including is there. Right. But you know the word center will create an issue because all of these guys.
So without center also, including the word is there. That means apart from other things, including the fitness and health centers.
Exactly. So that was a doubt only in my head actually. So I wanted to pick everybody's brain on that as to whether only I am thinking that way or others also are thinking that way only. But you are right. It will get covered under physical well-being services. I don't even have to look at whether there is a center or not. Okay. Now let's move to the most important aspect of GST. Sir is already looking at time. Right. Give me like 10-15 minutes, sir. I'll try closing whatever I can. Okay. A very important issue of credit note, because whether it is SGST office or CGST office, the most important, the most common issue in audit or in show cause notices, you have claimed credit note to this extent. Either you have not been able to satisfy why the credit notes were issued, or you are not able to satisfy whether the recipient has reversed the credit or not, and so whatever credit note has been issued is being disallowed. You are required to pay tax rate of 18% plus interest and penalty. Correct? All of us have got that notice, right? To maybe simplify that or to maybe complicate that, they have issued some circulars. They have also proposed some amendments in the Act. We'll look at all of these. Okay. First, let's look at one common question which came up again because of this 22nd September. I sold the goods at 18% on 21st of September 2025. Okay. My customer sent back those goods on 25th September 2025 after the change in rate of tax, and the new rate of tax is 5%. When I am raising the credit note now, the credit note should be 18% or 5%?
18%.
I will repeat again. When I sent the goods, 18%. When I got back the goods, the rate of tax on same goods is 5%. So now, when I am issuing the credit note, is it 18% or 5%?
18%.
How many of you 18? Excellent. How many of you 5? Only one. Right? Nobody else? According to me, and it's very clear also actually, when you are issuing credit note, you are not creating a fresh supply. You are cancelling the original supply. Right? You are negating the original transaction. So the rate of tax applicable on the invoice will continue to be applicable even on the credit note. Right? So if the supply was at 18%, the credit note also has to be raised on 18% only, even if it means that the credit note was issued in the fresh regime where the rate of tax was this. Clear? But this was a question which came up quite a lot of times. Second, my goods are exempt after 22nd of September 2025, but before that it was taxable at say 5%. Okay, I sold the goods on 20th of September 2025. On 25th of September, the customer sent back those goods. I will issue credit note, no problem. I will issue credit note on that, right? But what do I do with the tax adjustment? Because all my output is exempt from tax. So what can I do?
Add it to cost.
Sorry, add it to cost. Very easy answer. Like our fees, add this also to the cost. That's all. Right? Understood the question? No? I don't have any output tax at all. What will I do with this credit adjustment? Right? You can claim refund of that because what you have paid as tax, once the credit note is issued, supply is cancelled. GST is applicable on supply. The moment the goods have returned, supply is negated, you can claim refund of the same. Clear? So if there is any credit notes arising on a business which does not have any output tax in the future, you are entitled to claim refund of the same. In fact, there was one circular which was issued, and they had to bring in a module also on the GST portal which has not come, which said, if you are a customer to a real estate developer and you cancel the apartment after 3 years, he does not have a time, he has a time limit to issue credit note now, so he will not be able to issue the credit note. So whatever taxes you have paid, because you have cancelled the apartment, there is no underlying supply which you have received, you as a customer can claim refund of the same. Right? Because there is no supply at all, and when there is no supply, GST cannot apply. Clear? Now, there was a circular which was issued just in September, maybe 2 or 3 weeks back, okay, where they have clarified on 3 major issues, and I will cover each of these 3 issues one by one. Okay. There have been a lot of cases where instead of complying with all these credit note requirements, linking it to the invoice, showing documents to say that it is a pre-sale agreed discount or post-sale but pre-agreed discount, and maintaining all those documents which the officer will never be satisfied with, I came up with a shortcut. I will issue financial credit note. Clear? So there the issue was, there were 2 issues. One, financial credit note was viewed as you have provided some services to your customer because it was appearing as other income. Correct? It was appearing, either you can reduce the purchase or you can show it as other income in the profit and loss account. The impact on net profit is the same. But for GST department, it is other income. GST is applicable on all goods and services. Anything which is not goods is a service. Right? So they would charge tax on other income also without even identifying HSL. Right? Or they would say to the recipient, look, you have got a discount. To that extent, you have not made the payment to your supplier, so please reverse the input tax credit. These are the 2 issues which are coming on a financial credit note. They are very clearly clarified on the second part. Financial credit note does not trigger any reversal of input tax credit as far as recipient is concerned, because there is no tax adjustment by the supplier towards his output tax. That is the first clarification. Clarification was not required, but our officers require that clarification, so this clarification has been issued. The first question, I will come to that, other income, how to tackle that, I will come to that a little later. Question number 2 which has been addressed in the circular is, post-sale discount is given by the manufacturer. Okay, what is the treatment of this post-sale discount? Let's look at an example. Okay, iPhone, which series is getting launched now? 17, huh? 17. What is the price of iPhone 17? Sorry? 1,70,000, 1,50,000. Right, 1,50,000 rupees, I am assuming. I am really bad at following prices of iPhone, but 1,50,000 rupees for iPhone 17. The moment that is launched, iPhone 16 prices would have got reduced. Assuming it was selling at 1,20,000. Assuming dealer has picked it up at 1 lakh rupees. Right? And assuming it was selling at 1,20,000 rupees, Apple puts up an ad on Times of India that iPhone 16 will now be available at 90,000 rupees. Distributor purchased at 1 lakh rupees, was supposed to sell at 1,20,000 rupees, but looking at the advertisement, customers will expect that the phone will be sold at 90,000 rupees. What will the manufacturer in the back end will do? He will give a 30,000 rupees discount to the distributor. Otherwise, how will the distributor sell phone purchased at 1 lakh at 90,000 rupees and lose 20,000 profit and cost of 10,000 rupees? So 30,000 discount will be given. So there the circular says, look, there could be 2 situations. If the manufacturer and the end customer have entered into an agreement where it has been told to the end customer that go to the distributor, he will sell the product to a discounted price, and to the distributor the manufacturer says, whatever discounted price is there, I will compensate for you. If that kind of agreement is there, there will be a separate treatment. But if there is no agreement, then it is a post-sale discount purely between the manufacturer and distributor, no tax impact. So in our example of iPhone, because there is no direct relationship between Apple, that is the company, and the end customer, which is you and me, that 30,000 rupees discount given to the distributor, there will be no impact in the hands of the distributor. But let's look at another example. Okay, Lenovo enters into an agreement with, say, employees of TCS and says, whichever employee buys Lenovo laptop by giving their employee code, okay, and some promo code, I will give them 5,000 rupees discount. Right? This 5,000 rupees discount will be given, but the sale will be through a distributor and I will compensate the distributor. Now, because of an agreement with the end customer, the product is being made available to the end customer at a discounted price, for which compensation is being paid by the manufacturer to the distributor. That will be treated as consideration and will be liable to tax in the hands of the distributor. Is this clear? I don't know how it will get implemented. I have a lot of practical issues or challenges which I see on this. Okay, but that is what has been clarified. That, say, let's look at another example. Okay, we have seen this in automobile industry. There is a corporate discount which is given. Okay, that is basically if your company is empaneled with that with the automobile dealer, you give your employee ID and it is validated, you will get discount in the range of 5,000 to 10,000 rupees because Toyota has entered into contract with one of the, say, Infosys. Okay, and Toyota will give this, pass on this discount to the distributor, saying you have sold car to the employee at less than 10,000, by 10,000 rupees less, I will pay you that 10,000 rupees. In these cases, when the distributor of Toyota raises invoice on the employee or on the company, they will have to also take into account the money which they will get from the OEM and discharge GST on that as well. While they will get 10,000 rupees less from the employee, but invoice will be plus 10,000 and plus GST on this. Clear? The third issue which has been clarified, and that is the first issue which we discussed some time back, is post-sale discount offered by the manufacturer. Again, they say there are two situations here. One is, it is not a service which the distributor is giving to the manufacturer, it is a volume discount. See, when there is a manufacturer and there is a distributor, manufacturer has sold the goods to the distributor. Now manufacturer says, if you sell more than 1 lakh units, I will give you 2% extra, and that comes as other income. They are saying it cannot be a service. Distributor is bothered more about his sale than manufacturer's sale. He wants to sell more because he will earn profit, not because manufacturer will get more profit. So he is not providing any service to the manufacturer. That is the service which he is providing to himself by boosting his sales, and so the discount what he gets will not be liable to GST. However, if a specific sales promotion activity is taken by the distributor and there is a specific contract which says distributor will take some specific activity, and that contract specifically says that you will get additional consideration for the work which you have done, in that case and that case only, the consideration received from the manufacturer will be liable to tax. Is this clear? Now, like I said, there are some amendments also, and amendments which have been effected and amendments which have been proposed. I'll project all these four together. Right? There is section 15, subsection 3, which allows for reduction in value of supply by way of post-sale discount. Right? There is section 34, which talks about issuance of credit note. Right? But there was no cross-referencing between section 15 and section 34. So what now has been proposed is, section 15 will be amended to bring in reference of section 34, so that whenever you give post-supply discount, you will have to raise a credit note. And section 34 says, for the purpose of section 15 also 34 can be used, because section 34 is very clear, it can be used only for specific situations which does not include discount. So that cross-referencing they are going to bring, it has not come as of now, that cross-reference has to be introduced. That means amendment will have to be introduced. Second, section 15, circular 212 of 2024. Why do I remember this circular? Intentionally I wrote it down, otherwise I am very bad at remembering these circular numbers and notification numbers. Right? So circular 212 of 2024 said, if you want to claim deduction of discount, you will have to get a declaration from your customer or from the chartered accountant of the customer if the value is more than 5 lakh, that they have reversed the input tax credit. Now they are trying to build in all these conditions in IMS, and that is why I hope that is why they have removed this circular. At least for the present audits we are safe. Till the time IMS is not mandatory. Maybe after 2 years when the audit gets picked up, when IMS became mandatory, we'll have to see how to address. But as of now, because that circular has been withdrawn, we are not required to give any declaration. Then section 34 has already been amended effective 1st October 2025, that the deduction of credit note will be available only if the recipient has reversed the credit. Now how do you prove that the recipient has reversed the credit? Only IMS, whether accept or not accept, you can prove, only that is the proof you have. Otherwise, whether the circular is there or not, you will have to get declaration from your customer for audit documentation purposes. Okay. I know I have run out of time. Just give me 5 minutes. Okay. GST tribunal is going to set up. We have been listening about it for quite some time, and I will not be surprised if they miss this deadline also. Okay. But the due date of filing the appeals has been fixed. It is 30th June 2026. It is in a staggered manner based on the due date of the first order which you have got. So there are a lot of calendars available online through which you can check when you can. But the last date is 30th June 2026, right? Within which you are required to file the appeals for all the past period. For orders issued from 1st April 2026, from the date of communication of the order, you have 3 months time, right? Pre-deposit at appellate stage, that is the first order, you would have already paid 10%. Whenever you are going to file a appeal before the tribunal, you are required to pay additional 10%, but a circular was issued again to say, if you want to file an appeal, file a declaration with the GST authorities, that is your appellate authority, that you intend to file an appeal, and along with that declaration, make a pre-deposit of 10%, right? So that declaration has to go and 10% will also have to be paid. Now, effective 1st October 2025, another amendment has come in the appeal filing process where they said, if your demand relates only to penalty, okay, earlier the pre-deposit was calculated 10% of the tax amount. Now even on the penalty you will have to pay tax, you will have to pay pre-deposit of 10%. Now the issue which comes up is, up to 30th September 2025, I had an order which was dated before 30th of September 2025 of course. At the first appellate stage, I have not paid pre-deposit because there was no condition only required, because the order only relates to penalty, right? Now this order is coming up before tribunal. Okay, and I have to pay pre-deposit now because I am filing after 1st October 2025. Now the pre-deposit which I have to make is 20% or 10%. You followed the issue, right? I was not required to pay pre-deposit at that point of time, so I have not paid. But now when I am going before the tribunal, I am required to pay a pre-deposit. So will it be 20% or 10%? In my view, if you look at the language also, it says 10% in addition to whatever you are required to pay under 107. 107 at that point of time was 0. So I have paid 0. Correct? What I am required to pay is only 10%. Yeah? Next issue is, can such pre-deposit be paid using ITC?
Yes.
Pre-deposit of penalty. My order is only relating to penalty of 1 crore. I have to pay 10 lakh rupees. Is it by cash or by credit?
Cash.
Cash? How many say cash? How many say credit? Others? Lazy. Why to pay pre-deposit is the question, huh? Then what is the answer? Others, I didn't understand. Sir, why cash?
Because fees, interest or penalty has to be paid by cash only.
I am paying pre-deposit, which is not in the color of tax, which is not in the color of interest, which is not in the color of penalty. It is a pre-deposit. In my view, ITC can be utilized. But subsequently, if you get an adverse order, okay, how to adjust? Will you pay entire 1 crore and claim refund of the ITC? I am not sure about that. But today if you ask me whether pre-deposit of penalty can be paid by credit or not, according to me it can be paid, because there are a lot of judgments which are available. It says pre-deposit is a deposit, it does not have any color at all. So it cannot be linked to a tax, it cannot be linked to interest, it cannot be linked to a penalty. Manner of computation is penalty, but the color of pre-deposit is pre-deposit. Yeah? Now, another issue which keeps coming now and then, like our friend Pramod has come, now and then it keeps appearing, is intermediary services. They said in the GST Council meeting that from now on export benefit will be given. The point was, intermediary services, the place of supply is the place where the service provider is located. So if I am in India, I am providing intermediary services to my customer outside India, place of supply is where I am located, so it is not treated as export because the service according to law was consumed in India itself. Right? They are saying no, we will change it from location of provider to to location of recipient. So that means from 22nd September 2025, all intermediary services are export. This requires amendment in the IGST Act. Amendment in the IGST Act, I am assuming, will come in the Finance Bill 2026, which will have to be enacted. All the states will have to, amend the SGST law. Only then this will come into picture. Till then, whatever was the position for intermediary earlier will still continue. I've seen a lot of people saying, intermediary services now no need to pay tax, it is export, you can claim refund. I am sorry, till the law does not get amended, intermediary services position still continues. But once this position is clarified, the next issue which will come, if I have to pay taxes, because if I am availing intermediate services from outside India, it will become taxable now, because location of recipient, should I pay CGST, SGST or IGST? I have no answer to that. Okay. Second amendment which has become effective 1st July 2017 is plant or machinery in 17(5)(d) has been changed to plant and machinery to overcome the Supreme Court ruling in Safari Retreat. Okay. There have been instructions which have been issued to clear the refund of 90%, like the audience is getting cleared. So to clear the refund applications up to 90% within 7 days, okay, including, though inverted duty structure, the amendment has not been made effective in the law, but the instruction says the same guidance will have to be used even for inverted duty structure as well. There have been some amendments which have been made in GSTR 9 and 9C. One of them, which is the most, frankly, they realized it a little late. Last year credit claimed in the current year will get removed, so that at least we will, to that extent, I am hoping that we will get lesser amount of notices, right? That was all I had. Thank you so much for being a patient audience. I'd be more than happy to stay back and take all your questions if you have any, right? We run a community where we keep sharing updates on GST. Please feel free to scan and get added to our GST community, right? Right, any questions? Yes, Sanjay.
See, one of the things that we do is we buy stuff from Amazon,
Okay.
where we are set up as a business entity.
Okay.
And there are goods that we purchase which is for business, and goods that we purchase which are personal in nature.
Right.
Now, because it's just one login, everything comes under the GST.
Right.
So on the IMS, we are just accepting those that are business related, the rest we are rejecting.
Right.
Will it have an impact, on us or on Amazon because we rejected that output? For them it's an output, for us it's an
No, don't reject it, avail it and reverse it. Or now there is an IMS new provision where it says, on that invoice, how much amount you have claimed as credit.
See, if I avail it, then I have to bring it in my books. I don't even want to bring
You
it.
don't have to bring it in your books, because on your IMS you are availing and reversing. It is not forming part of your electronic credit ledger, right?
Yeah, it is not. But because I'm availing it,
See, accepting does not mean availment.
I know. But we follow a practice that whatever we have accepted, at least once it should be in the books, and then from there, either it's expense directly or it's reversed, the books also.
I'm not sure from Amazon what will be the impact, because they are anyways admitting that liability. Just because you are rejecting it, their liability is not getting reduced. But in future, if that kind of a system comes in, then I am not sure about the impact. But as far as ITC is concerned, only because you are accepted does not mean you are availed.
So now when I'm raising credit notes on my customer, where the original invoice itself was a dispute, they never availed their input. And now I'm raising...
That's why they have changed the IMS now. So now you can say on that invoice how much credit you have claimed, or if you have not claimed, you can mention the entire value. And then you can issue the credit note. That issue was there, but I think in the new IMS, which was the guidelines which were issued like last month, we will see the effect of that in the current IMS. I hope that issue gets resolved. But that was the issue. I have not availed the credit on something. Now I am required to accept that credit note. How do I account for it? In the current IMS, they are trying to resolve that issue.
So in this case, the customer is not going to do that also, right? He is going to reject that credit note because he's not taken the input.
That's what they are trying to address in the new IMS is what I am trying to tell you. The instruction or the press release, they say, the advisory, they have addressed this specific issue where originally you have not claimed the credit.
But still there is a dependency that the customer takes some action. If he wants, if he's not reachable, not accessible, no longer we have a relationship, then he's just simply going to reject it, which will have an impact on us, right?
That will be there. You have to keep all your customers in good books.
Sir, is there any change in GST rate for garments sector after September 22nd? Before it was 5%.
The 5%, I think, I don't remember the rates offhand, but garment still continues to be 5% only. I don't think there is any change in rate of tax, but I don't remember it offhand. I'm really sorry for that. See, only what I remember is wherever it was 12, now has been changed to 5 or 18. 5 has remained 5, and garment I remember is 5, so it should not have undergone any change.
Sir, this is regarding Rule 42 2A reversals.
2A.
This final point of reversal is 30th June of the next financial year, immediately next financial year when the project completes. Let's say we have started project in 2017 itself, and now we have completed the project, and the reversal have not been done properly, and the audit assessment.
The proper officer is checking the improper reversal.
Yes, sir. And now they are asking me to reverse for 17, 18, 18, and 19, 20, which they can't even issue 74 also. Under which provision they may ask me to reverse?
You should ask them.
Yeah, that's what I can. Then
I would go one step ahead.
Okay.
How are they calculating that reversal?
The formula.
Total credit multiplied by unsold area divided by total area.
Yes.
Correct?
Yes.
When did that formula come?
It is
1/4/2019.
Yes.
Correct? Before that formula only was not there.
Yes.
They cannot ask you for reversal. Second, please refer to Gujarat High Court decision in case of Alembic Corporation. Alembic Corporation or Alembic Construction. I am sure it is Alembic Corporation. Same rule 6.3. What there it is, total project credit multiplied by unsold area divided by total area. The department asked for reversal of credit in Selmat Credit Rules Rule 6.3. The court said, look at your formula. It requires annual credit reversal. OC has come in 2017, March 2017. Only 16-17 credit you can subject to reverse. Earlier credit, nothing can be done. Use that same logic here. 17, 18, 18, 19, 19, 20. No OC received. Your formula came in 1/4/2019. You cannot apply the same formula for the earlier period. Earlier period, year-wise you have to check. Year-wise I did not have exempt turnover at all. So no need to reverse the credit. They will not accept.
So what can be the proposed solution for the credit notes which are inadvertently rejected by the recipient? So if they reject it, my 3D liability gets increased. So as of now I have no answer to that. So manual correction in GST or 3B table 3?
Manual correction you can do. That is allowed.
But what if they freeze the figures going forward, section 38 amendments and all comes?
You have to keep calling your customer saying, please, my bab, something you please do.
Okay.
Right. Thank you very much everyone. Thanks a lot to the Bangalore branch again. Thanks Nithin. Thank you very much.
Members, that was a fantastic study circle meeting for 3 hours on both income tax and GST, both by CA Nithin Surana sir and C. Hanish sir. A big round of applause for both the speakers for today's wonderful session. I am Vinod Garg, Managing Committee Member of Bangalore Branch, and on behalf of all the members present here, I request Chairman of Bangalore Branch, Manjunath M. Halur sir, to present a token of respect and gratitude to both the speakers. Thank you, Chairman sir. Thank you, sir. Members, tomorrow we have one-day seminar on tax audit at Baswantpuri National College. I request all of you to kindly register for it. Thank you. Thank you one and all.